Here are the top stories. Wall Street slides as turmoil at First Republic rekindles fears of a US banking crisis. But US futures rebound after beats at Microsoft and Alphabet reassure investors this year's tech rally has room to run. The companies outline their visions for AI. Plus, Standard Chartered reports its largest quarterly profit in 9 years. That's as rising interest rates boost its bottom line. We'll hear from the CFO this hour. Let's check in then. Futures pointing lower across the European session, down 0.5%. A mixed picture, a divergent picture between the futures in Europe and the futures in the US. And is tech the safe haven now as the banking crisis rears its head once again in the US? The asset sales that have been whaled by First Republic, will anyone come and snap those up and provide that relief? A major question as we look at the banking space with increased scrutiny in the US once again. The FTSE 100 currently off just by a couple of points. We'll wait and give it a few seconds to reflect, of course, what is happening across these markets. You saw a sharp move lower in yields, particularly at the front end, and we'll touch in on the 2-year in just the next few seconds. About 18 basis points move lower at the front end, again, on those risk-off moves yesterday on concerns about the banking crisis. But the tech story does ride to the rescue, at least for now, temporarily, and the resilience around the big names and the blue chip tech stocks in the US, particularly with the focus on cloud coming through for Microsoft, and then forward-looking on AI as well. The Spanish IBEX currently down 0.4%. Here in the UK, the FTSE off by 0.2%, a drop there of 15 points just in the first few seconds of this open. Cross-asset, let's switch it over. A different picture when you reflect on the futures with that particular focus on the tech space again. The upside that is expected to come through, particularly for the tech-heavy NASDAQ, 1.3% on the futures there. The 2-year 392, just to move 3 basis points again after that sharp move in yields of 18 basis points yesterday. 392, so firmly below that 4% level at the front end of the US curve. 110 on euro dollar, that's a gain of 0.3%. Brent back above, comfortably back above $80 a barrel, $81 a barrel. Of course, you're tying that in to the picture around China and the health of that economy. We have a significant meeting taking place in Beijing this week between senior leaders expected in terms of additional moves to support and propel that economy, even as the fiscal taps will remain largely closed as they try and ensure that their work on debt stability is maintained. Now, Asia stocks headed for their lowest close then in a month, hit by renewed concerns about the global banking crisis. Let's get more on the market reaction and with Bloomberg's Christine Aquino. Christine, 2 narratives coming through then. Tech performing well with the big names coming through with some decent earnings, but the banking crisis seems to be back as a key risk for these markets.
Absolutely, Tom. And yeah, very interesting kind of divergence there, given that the banking turmoil was really what was moving markets initially. But yeah, a lot of undercurrents in these markets at the moment. And I feel like one of the themes that has really cropped up is one of divergence, even within the tech sector itself and the banking sector separately. I mean, of course, you know, we saw the beats overnight from some of the big tech names. And so there is once again this idea that, oh, perhaps big tech is starting to become another sort of haven in this sort of environment. Of course, you know, a lot of investors still staying away from profitless tech and smaller tech companies, still very much affected by the current challenging environment. And I think same for banks as well. You know, we have had a number of big US banks reporting decent earnings, and and kind of reassuring investors that everything is kind of settling down after the March turmoil. Not so for smaller banks. First Republic still very much undergoing that deposit flight, and investors just increasingly worried about its existence, essentially. And so you're starting to see really divides, right, between the Goliaths and the Davids, both in the banking and tech sectors.
The David and the Goliaths within the banking sector. As the safe haven play unfolds, it's not really a picture that is getting much traction when it comes to Chinese technology. That stock, or at least mainland equities, Chinese equities, giving up about $500 billion in terms of market value. Chinese tech stocks are back today, reading into what's happening with the US and the handover there in terms of the earnings picture. But does China become a headwind for global markets or a catalyst?
Yeah, very good question. I think the jury's still out at the moment. I think there was a lot of hope being pinned on China's reopening as being one of the drivers of global growth this year, especially as we expect a bit of a slowdown in the US potentially. But I think what we're seeing now is that that isn't, you know, the absolute all-in positive trade that investors were really expecting. And I think a lot of that has to do, of course, with regulation and what we're seeing as well in just China's governance at the moment. There's a lot of things that are in flux at the moment there, things that don't necessarily make investors feel very comforted at the moment. They don't like uncertainty, especially in this sort of environment where everything else is already very challenging. And so any sign of kind of setbacks in China or any sign of kind of regulation stepping back up again, definitely something that would give investors pause.
Yeah, and that uncertainty certainly persists, particularly, of course, around geopolitics. Christina Kino, thank you very much indeed for the market reaction to the earnings picture and the broader macro as well. Talking of macro, let's bring in now Valentine Ainuz, the Deputy Head of Developed Markets Research at Amundi Institute. Valentine, good morning. Thanks for joining us. Let's start on the banking crisis then. Were markets too quick to put the banking turmoil to one side? How much more tightening in credit conditions and loan standards do you think comes through from what is emanating out of US banks?
Well, yes, we clearly think that now when you are looking at the US economy, it looks quite resilient. You have the US service sector that remains in expansion. The US economy continues to add jobs. US households still have a lot of excess savings in their hands, so that's continue to support consumptions. But all these indicators only give us some backward-looking information regarding the US economy. And the most important point now is the tightening in credit conditions. And we clearly think that this stress in the banking sector will accelerate this tightening in bank credit conditions. So the lag.
So that further acceleration is there. So I just want to get your view then on how you tie that in to the decision of the Fed in May. The market's starting to pull back on their bets that this is a done deal for a further hike in May. About an 80% probability now. Valentine, what do you think the move is going to be?
I think we expect still the Fed to hike interest rate by 25 basis points. For the Fed, the global situation has not really changed. You still have a high level of inflation and tight labor market. And when you are looking at the supply is still constrained, still missing in the job markets between 2 and 3 million people. And the US level of residential inventory is at historical low. So for the Fed, for me, the situation has not changed. The Fed should continue to hike rates. So we expect another hike of 25 basis points. And then we expect the Fed to maintain rates higher for longer than what the market is currently expected. But at some point, we expect this tightening in credit conditions to trigger a recession in the US economy. And the disinflation will accelerate as the US economy will enter a recession. The good news is that the Fed's policy is working. You have some lower pressure in inflation, and the US job market, even if it's now very tight, is cooling. There is a decline by 20% of job openings. And the very important point is that we are starting to see some some job cuts in growth-sensitive sector. So the Fed's policy is working, but the Feds will have to maintain rates in restrictive territory for longer than what is expected by the market.
Okay, interesting. So higher for longer is the call then from you and the team at Amundi. We did hear, and we saw a note come through from Stephen Englander over at Standard Chartered, making the case for a dovish pause in May, saying that a dovish hike would ease financial conditions. That would be a risk, and a hawkish hike could destabilize the markets further. Stephen Englander, again at Standard Chartered, making the case for a hawkish pause in May to give the Fed further optionality. What is the pushback to that view?
I think that the Fed wants to lower the demand, to have the demand and the supply better aligned, and the Feds want financial conditions to tighten. So this is really something the Feds want. So clearly, my take is that the Feds will continue to maintain interest rates in restrictive territory. So I really expect the Fed to continue to hike rates. There is no clear reasons now for rate cuts.
Okay, is the bid for the front end of the yield curve overdone then at this point? 390 on the 2-year. Do you think the yields have to go further higher from here? Is there too much of a run into the front end at this point?
Yeah, but the point is that I expect the market to start to price more rate cut as the U.S. economy will enter a recession. The first point, the starting point from our call is that we expect the U.S. economy to enter a recession in the coming months. And it's not really priced by the market right now, especially for the corporate sector. The major risk remains now on the corporate sector where this risk is not priced.
Okay, and what is the credit call then? What do you like in credit as you weigh up those recession risks in the US?
I think that the corporate debt market is not pricing a recession now. It's really important to understand that the US economy exited the COVID crisis with a lot of cash. US households, they have a lot of cash on their balance sheet. American companies have also exited the COVID crisis with a lot of cash on their balance sheet. And American companies have not so far been significantly impacted by the tightening of the Fed's monetary policy. They have used the cash accumulated during the COVID crisis, and their refinancing needs so far has remained low. But we expect corporate default to rise in the second half of the year, and this is not priced by the market, so we remain quite cautious and high yield, and we do favor IG versus high yield.
Okay, favouring IG on the risks of further defaults, at least in the second half, that not being priced into the markets. Higher for longer from the Federal Reserve with another hike coming through from May. The call's there from Valentine Aynouz, Deputy Head of Developed Markets Research at Amundi Institute. Valuable insights this morning to get the show underway. Thank you. Let's check in on one of the stories, one of the corporate stories in focus for us today. Of course, earnings continue to be dominant this week. This one, Dassault Systems, it's a miss in terms of revenues, missing the estimates, and the stock taking a big hit on the back of that, currently down 6.5%. That is Dassault Systems, of course, listed in France, a miss when it comes to ex-FX revenues for the first quarter. Coming up, Standard Chartered, different story there, beating estimates as higher rates boost profits. We're going to bring you our interview with the CFO of that bank, Andy Halford. That is next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to the Open. We are 14 minutes into the European trading day. The banking turmoil rearing its head again in the US with First Republic and its plans around asset sales in focus. The stock, of course, tumbling before the trading was suspended yesterday. Different picture when it comes on the earnings front, with technology coming through pretty strongly. We're going to get the details on that in just the next few seconds. Across the benchmark here in Europe, you're seeing losses of 0.5%. The Nasdaq futures, though, pointing to gains of 1.2%, and that does tie us in to those tech earnings. Microsoft, third quarter profit then, and sales coming in better than expected, boosted by resilient cloud computing demand. And Alphabet's results also beat estimates as its cloud unit turned a profit for the first time. To get the details then, the analysis and what it means going forward, Matthew Bloxham from Bloomberg Intelligence. Matt, what are your key takeaways then from earnings that look pretty solid from blue chip tech?
Yeah, I think actually, as you said, better than people were expecting. People are a little bit cautious coming into this print. I think three things stood out for me. One, as you mentioned there, that enterprise demand for cloud services held up. You know, we were seeing year-on-year growth rates of between 25 and 30% for the cloud businesses of Alphabet and Microsoft. To that
25 to 30% in an environment where we're all freaking out about recession risks and cutbacks. That seems pretty solid.
Yeah, exactly. It tells you that enterprises know that they need to continue to invest in technology to make themselves more efficient and productive. So that was one thing. I think the second was that Google's search business has a still incredibly strong moat, generates over $40 billion in the quarter of ad revenues. So these kind of worries that, that there's an advertising slowdown or there's this pressure from Microsoft not coming through yet. And I think it shows just how strong Google's ad business is. It's basically the kind of the default banker for advertisers. If they cut other parts of their budget, they're going to continue to go with Google because they know that it's going to get a really good return on investment.
It did feel a bit premature, didn't it? The risks around OpenAI and the threat to Google. They've clearly got to wake up to this.
Yeah, exactly.
What's your sense of to what extent that 40 billion or so is going to be sustained?
Yeah, I mean, I think in the short term, it's definitely going to be sustained. And this is my third point. We saw a huge amount of conversation in both earnings calls about generative AI and contrasting opinions. So clearly, Microsoft saying this is a disruptive moment in the industry and things are going to change. And we're going to gain massive amounts of share with Bing thanks to this. Google saying, calm down, we've been in this industry for a long time. We know this business inside out. We know what consumers want. We know what advertisers want. We are developing AI as an evolution of that market-leading product. Don't worry, trust us. This is going to be okay. We're not going to suddenly see a massive shift of our 93% share of online search to Bing. It's clearly a risk. They're making a very strong claim that they are aware of that risk. They're responding to it. They'll continue to protect their leadership, and they're actually being more efficient in other parts of the business so they can invest in it without squeezing margins too much.
We're seeing how those competing narratives evolve over the months, quarters, and years ahead is going to be really fascinating, isn't it? A great breakdown of these important earnings, the picture around AI in particular from Matt Bloxham. Thank you very much indeed, of course, from Bloomberg Intelligence on the earnings picture around tech. Let's get the Bloomberg Business Flash now with Sam Etienne. Sam.
Gucci sales barely grew in the first quarter as Kering's biggest luxury brand struggled to win more shoppers. Revenue at Gucci rose 1% on a comparable basis, missing analyst estimates, while sales at the division, which includes Balenciaga and Alexander McQueen, dropped 9%. The results stand in contrast to the strong performance of rivals LVMH and Hermes. And Ed Sheeran has told jurors he would be, quote, quite an idiot to perform two songs together if the copyright infringement claims against him were true. The singer's been taking the stand in a New York trial, accused of lifting melody, chord progression, and harmonies from a 1970s Marvin Gaye song. Sheeran denies the charges. And Apple is reportedly working on an AI-powered health coaching service and new tech for tracking emotions. Sources say it's planning to use its Apple Watch data to create tailored fitness programs and use iPhone algorithms to determine a user's mood from their speech as well as the words they type. The move is part of a push to make health features central to Apple's product offer. That's Bloomberg Business Flash.
Sam Metin here in London. Thank you very much indeed. Right, Standard Chartered reporting its largest quarterly profit since 2014, a little over 9 years. That's as rising interest rates boosted its bottom line. We spoke to CFO Andy Halford, who said the bank has remained, quote, very, very stable during the recent turmoil in the sector.
Top-line growth has been really strong for us, so we're up 13% on our top-line growth. We were up double digits last year, so the overall performance of the business has been fantastic. The profitability is now up at the levels we last saw back in 2015, so a long period of time since. Interest rates going up has clearly been a help in that, but also we have seen a lot of client demand as particularly the Asian markets now pull through the COVID period and start to look forwards.
Does that mean that even if the Fed, the BOE, stops hiking, that interest income margins will have peaked, or is this not the peak yet?
So last year, our interest margin was about 1.4%. We have said this year we think it will be about 1.7%, and we have said next year we think it will be about 1.75%. So we are sort of nearing a higher level, but still on the rise.
So if everything looks good, profitability is still strong, your figure of $5 billion worth of capital returns by 2024, would you say that's a conservative figure then?
Well, we need to start somewhere. So $5 billion, we are roughly halfway through excuse me, in terms of what we have announced so far. $5 billion coincidentally will be the amount that back in 2015 we raised as a rights issue, so essentially it will be handing that money back. But I'd say overall we're well on track for delivering the $5 billion.
Are you still fearful that the worst of the contagion, again, emanating from a market far away from yours, but are you fearful that perhaps that's not over yet?
There obviously have been two major issues in the sector, but actually for us as a business, we have actually seen our numbers stay incredibly solid. So our deposits have remained very, very stable throughout the period. So not that anybody is totally insulated from something going on in the sector, but I do think the fact our businesses are more based in other parts of the world. We are very spread. Our deposits are spread across many countries, many different types of client. I think actually our business model is a very robust business model for this sort of circumstance.
Well, almost, I mean, perversely, does it help you? And I'm thinking here specifically of Credit Suisse. Did you see flow that was clearly from them, clearly from their clients, especially in wealth management, fleeing Credit Suisse and coming into Standard Chartered?
I think if you look back over the last probably 6 months or so, particularly the last part of last year, we saw strong growth in our assets under management. I think some of that was probably helped by some shift away from some banks like that. So I think this will be a flight to safety. I think the bigger, more robust institutions that have been around a long time, are trusted, will be the beneficiaries of this.
In January, First Abu Dhabi Bank said it had explored a deal with Standard Chartered to buy it. Since February, it said it's no longer planning to do so. Have you had any conversations with them since? Is Standard Chartered, is the future still an independent bank?
We have had no discussion with them whatsoever. We are an independent bank. We are motoring well under our own devices. We're very pleased with our performance.
Andy Halford there, Standard Chartered CFO, speaking to Danny Berger about their strong numbers, despite, of course, the recent banking turmoil. Coming up, shares of Kering slide at the open on worse than expected Gucci sales. We're going to check in on your stocks on the move. That is next. This is Bloomberg.
a young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Welcome back to the Open. 25 minutes into the European trading day. Another risk-off day sparked, of course, by renewed concerns about the health of those medium-sized, smaller US banks. First Republic in focus, of course. Currently, across the European benchmark, you're seeing losses of 0.7%. Nasdaq futures, though, pointing to a different picture, gaining a little over 1%. Let's cross over to Joe Easton now for a focus on some of the stocks to watch. Joe, what's in focus?
Morning, Tom. So ASM over in Amsterdam getting absolutely slammed, down around 11%. That's the worst performing stock we've got in Europe today, and that's as they warn of a potential slowdown in orders as company cut their capex budgets across that space. So that would be in areas like smartphones and also PCs. The electric vehicle chips holding up a bit stronger, but as I say, that one getting hit hard today, Tom.
We've had LVMH and Hermes performing really well. Kering, different picture though.
So Kering really a contrasting story compared to LVMH. Gucci sales only up 1% in the last quarter. Analysts were expecting them to be up almost 3%. They say some aspirational buyers in the US are already cutting back due to the cost of living crisis, and that one is dropping 2% in Paris.
And you're also having a quick check on the builders here in the UK, Joe.
So Persimmon finally giving some relief to the home builders today, reporting an uptick in sales. They're predicting sales could reach around 9,000 this year in terms of new homes. That's pushing up that stock 3%. And across the home builder space, we're seeing some gains today.
Great stuff, Joe. Thank you very much indeed from our equities team, Joe Easton. Coming up, First Republic Bank considering the sale of $50 to $100 billion of its assets of part of a turnaround plan. We get the details. This is Bloomberg.
about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury. So you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Wall Street slides as turmoil at First Republic rekindles fears of a US banking crisis. European equities also dip. But US futures rebound after beats at Microsoft and Alphabet reassure investors this year's tech rally has room to run. The companies outlined their visions for artificial intelligence. Plus, Standard Chartered reports its largest quarterly profit in 9 years. That's as rising interest rates boost its bottom line. Let's check in on these markets then. Risk off across European equities. The banking crisis and First Republic back in focus. A reminder that maybe some were a little complacent, a little too soon in terms of calling an end to the banking turmoil in the US. It has and remains a challenge, and potentially a challenge for regulators as well. There's an argument, of course, that European banks are in a very different space. The earnings front, Microsoft, Alphabet, as we mentioned in the headlines, coming through strongly. And a reminder as well that for some, tech and big tech in the US is something of a safe haven in this environment. Speaking of safe havens, you've got a significant move into German bonds, and we'll check those shortly. But across the European equities then, losses of 0.7%, most pronounced in terms of what is happening in technology as a sector, interestingly. The DAX is down 100 points, the FTSE 100 off by 0.3% as the chief economist at the Bank of England warns on the lack of growth coming through from the UK and the concerns around further inflationary pressures coming through from wages. Let's have a look at how things are shaping up across your sectors then. A bit of a rebound when it comes to energy and basic resources. Basic resources flat, but energy gaining 0.3%. You have a quick look at oil and you're seeing a bit of a gain there, 0.2% for Brent, just holding above the $80 a barrel level. Three sectors in your green then: energy, telecoms and utilities. Technology at the bottom list down 1.6%. We're talking about central banks, of course. Riksbank coming through. This is the Swedish central bank coming through as expected from Bloomberg economists at 3.5%. So that is an increase in terms of rates by 50 basis points. Let's quickly check in on the krona. On the back of this move, it's actually weakening by 0.4%. So softening by 0.4% versus the euro. The euro rallying versus the Swedish krona by 0.4% on the back of this. There's concern, of course, around what these further hikes are doing to the housing market in that country. But inflation has remained pretty persistent as well. A real challenge for the central bankers of Sweden. Of course, Bloomberg Economics expects another, by the way, 25 basis points to come through in June before they stop their hiking cycle. So that is the line coming through from the Riksbank of Sweden. Let's get back to the banking sector in the US now. First Republic Bank said to be considering the sale of $50 to $100 billion of assets. That's part of a turnaround plan. Shares plunged as much as 50% as the full extent of the challenges facing the bank dawned on investors. Bloomberg's Charlie Wells joins us with the details. What is First Republic's plan then to rescue itself, Charlie?
Yeah, so really what we were hearing yesterday was this potential sale of $50 to $100 billion in assets. But when you think about what those assets are, you realize what a challenge this could be. Because something unique about First Republic was that they made a lot of single-family mortgages. So a lot of those assets are long-dated mortgages. Now, the problem in a higher interest rate environment is that those assets are worth less than they were before. So finding potential buyers could be very difficult. And what we've been hearing is that the U.S. government may need to step in to help with negotiations there.
Once again, is this unique to First Republic, or are the other smaller banks, the other mid-sized banks in the US also facing similar challenges? Is this idiosyncratic to First Republic at this point?
So in some senses, yes, this is idiosyncratic, right? So First Republic is a bank that made a lot of, loans to wealthy individuals. They were operating in that low interest rate environment. They made some interest-only loans where wealthy borrowers would not have to start paying back principal for 10 years. Now, that's great at building relationships with wealthy clients. It's not when you need to potentially sell assets and look for a buyer. Now, look, yesterday we saw PacWest reporting. They actually showed that they were able to stabilize. So PacWest is another regional bank out of California. They were able to show that they had some deposit stabilization, and they were rewarded in the markets. Post-market, their share price was up 14%. So there's some hope there that this may be very significant for First Republic, hopefully not for other regionals.
Okay, that's really, really important context. And talking of context, some great reporting for the team at Bloomberg around warnings about the stresses in the banking system last year, towards the end of last year. What do we know about these warnings?
So this goes back to last autumn when we were hearing a number of trade organizations related to banking, a number of lawmakers reach out to the Fed, reach out to the FDIC, saying that unrealized losses at a lot of these regional banks could potentially turn into actual losses that could harm the economy. Now, this is coming into focus because an official at the Fed will be releasing a report on what happened at SVB on Friday. So going forward, we're going to hear a lot of shoulda, coulda, wouldas, but easier said than done.
Yeah, as they continue that review, of course, Charlie Wells with the context around First Republic and, of course, what the Bloomberg team has been learning about those warnings around the stresses on the banking system in the US. Thank you very much indeed. Let's get the first word news now with Sam Etienne. Sam?
Tom, renewed fighting in Khartoum is testing a fourth attempt at a nationwide ceasefire in Sudan. Smoke was seen rising from the presidential palace in the country's capital yesterday, with violence also reported in nearby cities. The UK, meanwhile, has begun evacuating British nationals amid mounting criticism. It's been slow to react to the unfolding conflict. And BOE chief economist Hugh Pill says the British people need to accept they are poorer instead of seeking to claw back a historic drop in living standards. Pill told a US podcast that a tight jobs market and strong pricing power means companies can pass on costs in higher prices, adding to further inflation. He says that a game of pass the parcel is one of the reasons UK inflation remains so high. And US House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking an increase in the debt ceiling with spending cuts. In a rare sign of how close the vote could be, the outcome may not be known until the roll call happens. Both moderates and conservatives in McCarthy's Republican Party have expressed doubts about the plan. That's your Bloomberg Business Flash. Tom.
Sam Etienne here in London. Thank you. Okay, staying on the earnings story. Dassault Systems has reported first quarter results this morning, for the most part in line with the estimates coming through from analysts. The CEO, Bernard Charles, has also recently risen into the ranks of Bloomberg's global billionaires. Bloomberg's Caroline Connor looked at his journey from intern to the C-suite.
From intern to billionaire, in 40 years, Bernard Charles has climbed to the top of French software giant Dassault Systems. Today, the chairman and CEO of the Dassault holding company's biggest business is a billionaire and one of France's highest paid executives. With a compensation package of about $36 million last year, he's not far behind some of Silicon Valley's highest paid bosses. Charles is the frontrunner to take the top spot at the Marcel Dassault family holding in the next couple of years, one of France's most influential conglomerates. Dassault's business goes back over a century. It has grown into an empire spanning aviation, media, real estate, software, vineyards, and an auction house. Investors might agree Charles's rewards are justified. Over the past 5 years, including dividends, Dassault Systèmes has been among the top 10 most profitable investments on the CAC 40. Perhaps little wonder he was named among the world's best CEOs by the Harvard Business Review in 2017.
Okay, Bloomberg has currently gone up there. Now, coming up, not Gucci. Shares of Kering slide at the open on worse than expected sales at its star units. We get the analysis more broadly for the luxury sector as well as Kering. That is coming up. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to the Open. Happy Wednesday, 42 minutes into the European trading day. You're seeing some pretty sizable moves across the asset classes and these markets this morning. In the equity space, the benchmark, European benchmark, is currently the European stock 600 down 0.9%, continuing to grind lower The biggest losing sector, by the way, is technology, down almost 2%. And then you have that safe haven move. We saw this pronounced at the front end of the Treasury curve yesterday with an 18 basis point move lower in yields. That continues today with about a 4 basis point move lower, but it's significant and pronounced around German bunds as well. Checking in on German bunds, you're looking at the 2-year at 271. That is a move lower in yields by 13 basis points. The euro is bid, as is the pound. Euro up 0.4% at 110, 124 on the pound. Don't forget, markets now are easing back on their bets around the May hike from the Federal Reserve, 80% probability and 4.3% by the year end. Again, banking crisis and the tightening coming through from that, and to what extent that will be considered by these banking officials. You also had from the ECB, Vucic, one of the members of the ECB's governing board, but also a member and the head of the Slovenian central bank, saying that we have no choice now but to continue raising rates. They may be giving a little bit of support to the euro. Talking of the euro, that takes us to the luxury space and the China input. Sales of Gucci barely grew in the first quarter as Kering's biggest luxury brand struggled to win more shoppers. Revenue at the flagship division rose 1%, just 1% on a comparable basis. Missing estimates, the Italian label generated about 2/3 of Kering's operating profit last year. Joining us to discuss is Carol Major, who is Barclays' head of European luxury research. Carol, really great to have you in the studio. What is going on with Kering? It's diverging from LVMH and Hermes, falling out of love with Gucci.
Thanks for having me. Yes, it is, and I think it's not really a surprise here, to be honest. So we had Barclays had in mind a growth of 0% for Gucci in Q1, so flattish, and of course it came out at 1%, so pretty much in line. I think the reason, of course, behind why they're so weaker is because they're in a phase of transition. So of course now you're expecting the new designer to come and show his first collection in September. They're doing a lot of changes internally to make the brand stronger and bring back this momentum. So I think because of that, of course, you have this weaker growth versus the peers. And of course, when you look at the market as well, I think Gucci is also a bit more exposed to this US consumer. And I think also this entry price consumer who has been a bit more under pressure in America, of course, on the back of the macro headwinds. So in my mind, this is the two key reasons why the brand has been weakening.
So the transition of the business,
exactly,
the vulnerability or at least the exposure to the US. You didn't touch on marketing campaigns. They've been hit by this. Balenciaga, for example, with the bondage bears, I'm thinking. And then in China, Gucci has been hit by some of its advertising that has soured the mood of some of their buyers in China. Can they put that behind them?
I think they can, yes, definitely. And to come back on the brand Balenciaga, so of course, I think the impact is mostly visible in the US market. So they have reported in this other house segment, which includes this brand, quite a weak growth over there. And from the call, they reflect that they expect an improvement by H2 on the brand Balenciaga. So for this controversy to pretty much be behind us by then, by the second half of this year. So hopefully it can back on track then. And I guess you come back on the core brand Gucci, I feel like as well on the call takeaways, they were quite convincing to talk about, what they are doing to make the brand stronger going forward. Of course, this year, this will be about, I think, closing the gap versus the peers and not outperforming them, which is really what we have to keep in mind. So they want to, hire the right people in the key markets, improve merchandising. I think straighten as well their exposure to these VIP consumers, which of course are doing quite well at the moment. And they also talked about reducing the exposure to the outlet shops, which I think is also quite important to improve this brand elevation.
Okay.
So in my mind, quite a good things to come,
so
of course, if they manage
closing the gap with their peers, but not outperforming.
Exactly.
You have an equal weight. You're not changing that. Equal weight on Kering with a price target of 588. We're at 573 right now. LVMH is a different story. Obviously, we've been talking about the fact this is a $500 billion market cap company now. And the price target for you, 948, further upside then from LVMH. You're overweight on this stock. Where does that further upside come from?
Yeah, I think so, further upside. So I think that, of course, when you have a look at the numbers published from them in Q1 a few weeks ago, it was quite a strong beat, I think, coming from the Chinese market. So in my mind, this is where I still see upside coming from in the luxury goods sector, the China consumer, who is still, I think, doing quite strongly. And of course, now we are entering in a phase with much easy comp base. So, Q2 last year was facing some big lockdowns in the Chinese market. So you should have some really easy growth to come in Q2.
But is that revenge spend, or is that sustainable upside that's coming through from China?
I think it's quite sustainable. I think that the appetite for the Chinese to buy luxury goods is still there, definitely. And of course, they will be also able to travel abroad a bit more this year, I think from Q3 onwards, maybe. And so you could also have a push of the offshore spending of the Chinese consumer coming back in the second half. So in my mind, you could have some upside coming from the Chinese, both on the ground and also offshore.
It's those two components, the domestic demand, but as Chinese increasingly travel to Europe and start purchasing again. That's interesting. The US, we're all debating the recession risks around the world's largest economy. The vulnerability of US consumers then, as we face up to slowing growth and that impulse to buy luxury.
Yes, that's of course a key concern right now in the sector. I think in terms of the investors I speak to, the US market is the key point of concern, of course, when China is of course now much stronger. And I guess what you have seen so far from the first Q1 takeaway is that you have some brands doing quite strongly. So of course, Hermes, for instance, reporting quite good growth in America, and some brands like Ferragamo or Gucci, I think brands who are a bit more exposed to this entry price consumer doing at a much weaker level. So I think in my mind, the more linked you are to the really VIP high-end consumers, the more I think protected you could be in this phase of macro headwinds. So again, the high-quality names like LVMH, Hermes could still outperform in this weaker environment in America, in my mind.
Is that the broader story then for the luxury space as we look to the quarters ahead, which is that it's the ultra-luxe that's going to remain in terms of margins and that demand that's going to remain strong, but maybe entry-level luxury, maybe affordable luxury, that the vulnerability is there. Is that broadly the picture?
I think so, yes, at least for the H1 earnings season. Yeah. In my mind, I feel like, yeah, at the moment, the high-quality names can still do better, and maybe by H2, when you have, a bit less concern about America, when the Chinese market remains quite solid, you can then maybe look around to more recovery stories, or maybe to Gucci doing better. Gucci last night also flagged that by Q2 and Q3, you could have some, easier comps in America. So I think that by then as well, you could maybe have some better performance for the Gucci brand in the second half of the year. But for the first half, I think that the safest bets are definitely the high-quality names, so names like Hermes and LVMH, on which we are overweight on.
Really, really great insights. Really appreciate you coming into the studio on the vulnerability as well, the concerns amongst investors of the US, but the resilience that you see coming through from China. Carole Madjo, thank you very much indeed.
Pleasure.
Barclays head of European luxury research. Coming up, the auto industry is undergoing some pretty interesting changes around the world. We take stock of Tesla's recent price cuts and Volkswagen in China losing the top spot to the local BYD. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back to the Open, 52 minutes into your European trading day. Bank fears again. Groundhog Day? No, it's all about First Republic. European stocks now, as a benchmark, a full 1.2% lower in the session. There's a move into euro, and there is a big move into the front end of German bunds. Let's take a look now at some of the other events we are following today. 1 p.m. UK time, ECB Vice President Luis de Guindos is going to speak at the Delphi Economic Forum in Greece. That's after his partner over in Slovenia said we have no choice but to continue raising rates. That is followed by data on US wholesale inventories and durable goods. That's at 1:30 p.m. UK time. And finally, Meta due to report after US markets close. And after massive cost-cutting measures, the company is forecast to return to growth after 4 quarters of declines. We'll see if they can match the kind of positivity coming through from Microsoft and Alphabet. Now to the story around EVs and, of course, Tesla. There is a raging debate in the EV space about Tesla's prospects. Some see Elon Musk as a visionary hero for the auto industry. Others think he's steering Tesla into trouble. Let's bring in none other than Bloomberg's Qatar, then Craig Trudell, who's been writing the story on this, the must-read of the morning. For the bull and bear case on the company, what are people saying about Musk the visionary or Musk the potential destroyer of Tesla?
I think it's really interesting, and obviously Musk has long been this sort of very divisive figure where you've had short sellers who've sort of been betting on this company not making it through the troubles that they were having a few years ago, ramping up their first car, to where you have the Cathie Woods of the world who think that this is the company that's going to change everything and sort of set the tone for the industry. You have, I think, a few different camps in terms of what to make all this. I think, interestingly, Ford's CEO sort of was encouraging reporters last week to, in his words, look up 1913. He was making a nod to Henry Ford and the sort of change that he brought about to the industry. The moving assembly line, his ability to price cars so much cheaper than the rest of the industry and really use that to his advantage and yet sort of in the end also come back to this idea of, Henry Ford was a little bit stubborn about moving on from the Model T. So you have this sort of debate over, just how much he's, doing this from a position of strength because Tesla has the scale with EVs that others don't. And how much is he doing this because he doesn't really have a choice? His product lineup is getting a little bit stale.
China's been a massive market for Tesla. They were out front. They had full ownership of their factory outside of Shanghai. And meanwhile, when you look at the dominance of VW that's been in the German company, of course, that's dominated that market in terms of sales. I'm thinking the VW Passat. It used to be on every road that you turned down in China for the last 20, 30 years. That's changed. Local competitors are there. Then they're just not nipping at heels of Tesla, but also VW.
Yeah, and this is a case where, BYD has sort of run away with the EV market in China. And of course, things are a little bit, iffy there where you see a lot of third parties look at that market, including plug-in hybrids, and you do have to separate things a little bit. But you have seen BYD really pull away from Tesla, and I think it is remarkable. This is a sort of huge milestone that we saw in the first quarter of BYD overtaking Volkswagen. This is a sort of, just an earthquake in terms of the biggest auto market in the world and just how much progress we've seen this company make. I think if you look at the chart on this story, just how quickly a BYD has overtaken VW. Just a few years ago, it was way behind Volkswagen. So this is something to watch.
The earthquake in the auto industry. Anyone who thinks that Chinese automakers can't innovate needs to wake up pretty quickly.
That's right.
Craig Trudell, thank you very much indeed on Tesla and the Chinese auto market. That is it for the European market open. Surveillance early edition is up next. These markets, equities selling off a full 1%. Futures in the US holding on to gains, though. The NASDAQ futures pointed to gains of a little over 1%. But here in Europe, there is a risk-off mood. Bunds are bid. The euro is up. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Wall Street slides as turmoil at First Republic rekindles fear of a U.S. banking crisis. But U.S. futures rebound after beats at Microsoft and Alphabet reassure investors that this year's tech rally has room to run. The companies outline their visions for AI. Plus, Standard Chartered reports its largest quarterly profit in 9 years as rising interest rates boost its bottom line. We're going to hear more from our interview with the CFO. Now, the markets maybe are faring better in the U.S. than they are in Europe. Europe has to do a little bit of catch-up with the sell-off that occurred in the U.S. yesterday. This morning, so you are seeing that fall. You're seeing Stock 600 fall about 1% so far. That's being led by tech. There were some weak chip earnings that's impacting that this morning, but it is a rebound when it comes to NASDAQ futures, considering the fact, as I said, both Alphabet and Microsoft earnings came in stronger, helping lift those. The 2-year yield, that slide continues, down nearly 5 basis points after a 13 basis point tumble yesterday, fueled by concerns around First Republic Bank. We're going to talk to our reporter Valerie Teitel about that in just a moment. But as always, it's a global bond market. Some bids when it comes to the front end of the German curve. 2 years there, down 14.5 basis points. So as I said, Europe in worse shape than the U.S. futures picture. Most of the, if not all these regions, are lower this morning. You have, for example, the CAC 40 underperforming, some concern there about Kering results, as well as Dassault Systèmes. So some of those big French companies weighing down on the overall index. Now, I mentioned First Republic. This is really the thing that moved markets yesterday and again continues to have ramifications today. It's said to be considering the sale of $50 to $100 billion of assets. It's all part of a turnaround plan. Now, those shares plunged as much as 50% yesterday, with the full extent of the challenges facing the bank dawning on investors. Let's get to Bloomberg's Valerie Teitel on this. Valerie, how close are we at this moment to First Republic going into receivership?
Look, the stock year to date is down 94%. They have been unable to stop these deposit outflows. The picture is not improving for First Republic like it is for some of the other regional lenders. Now, their asset sales that they're considering, 50 to 100 billion of asset sales. Now, if you look at their total loan portfolio, is 170 billion. So this is a sizable chunk they are looking to divest. Most of these loans are long-term mortgages, which are underwater, but they're hoping to offload them above market value by offering sweeteners to these potential buyers in terms of preferred equity or warrants. Very similar thing that was done in 2008 in order to give some upside to these potential buyers if, in fact, First Republic's balance sheet does look better after the divestiture of these loans. But the problem is First Republic is not the only one looking to divest their balance sheet at the moment. Other regional lenders are doing the same, and the FDIC still sits on billions, which it's also looking to divest. Danny, there are not many buyers out there who can buy loan books of this size. And the big worry is this all ends up on the FDIC's balance sheet as a liability to the U.S. taxpayer.
And we've seen that worry also filter through to markets, to Fed pricing.
Yeah, exactly. The most notable of what happened to the U.S. front end yesterday, we're now pricing in 80% of a chance of a Fed hike in May. That's just next Wednesday. And then also, if you look at how many cuts are priced in out to June next year, it's now at 170 basis points. That's more cuts than we ever priced in during the March banking turmoil. The conclusion is for many out there in the markets is that this puts a hawkish Fed next week, almost out of the question. And a big worry that the banking turmoil is going to turn into a long slog.
Yeah, maybe unfortunate for the Fed to be in a blackout period this week when this is all happening. Valerie, thank you so much. It's our reporter, Valerie Titel. Now, it's also been a big week for tech and a great start to the earnings for them. Both Microsoft and Alphabet reporting earnings that beat expectations, moving higher in the pre-market. Microsoft really taking up nearly 8%. Let's get over to Matt Bloxham from Bloomberg Intelligence on this. Matt, I mean, you see it there. Both of them outperforming on earnings, but a huge move in Microsoft shares pre-market. What's behind that?
Yeah, I think it's improved optimism about the top and bottom line momentum this year. They delivered something like 10% constant currency growth on sales in the quarter they just reported, and are guiding to about 9% growth the next quarter. So I think cloud demand is holding up better than they expected. And I think they also gave a really good pitch about their push into AI, obviously with ChatGPT, and kind of really, kind of pushing home that commitment to kind of build that platform and try to take some of that huge online search advertising share that Google dominates. So I think that they did a good job of convincing investors that they've got great momentum in the business. And I think AI will also help their Azure cloud business, because as more enterprise customers use AI in their businesses, they're going to need more compute power, which is going to drive cloud demand.
Well, on the flip side, it did seem like Alphabet was trying to brush off that competition. Should they be so blasé about it? Should they be confident that they can keep market share?
Yeah, I mean, I think they're clearly very cognizant of the risk, and they're putting huge amounts of investment into their own AI product development, and they reorganize some of their own units to kind of help improve their investment and focus on that. So I think it is a big concern. They clearly have an incredibly strong position in that market, and consumer behavior is pretty much ingrained in defaulting to Google for search. So I think that there are barriers for people like Microsoft to kind of get over, which are not insignificant. But these tech markets can move very quickly, and if they don't keep up with what we're seeing from ChatGPT, then there definitely is a kind of a mid to long-term risk. So they're conscious of that, they're responding to it, they're cutting costs so they can invest more without it squeezing quarters to see how this all plays out.
Okay, Matt, thank you very much. That's Matt Bloxham from Bloomberg Intelligence. All right, so we have a lot in terms of market news and moves to dig through. Joining us now to do just that is Bloomberg's Dana Al-Baltaji. All right, so we got tech, we got First Republic. I do want to start there just because of the huge reaction we saw in markets yesterday to it. What does this mean? The fact that we might have another failure of a regional bank, what does it mean for the Fed at this point?
It basically means that this priced-in hike, hawkish hike that people assumed was going to happen might not actually happen. And I'm not saying that it won't happen, but it just puts that uncertainty out there. Because at this point, I think people are starting to realize that the banking crisis that we had in March is not over. There is a crisis of valuation out there, and it didn't end with just SVB and Credit Suisse. It's everywhere. So there is a funding crisis. We're seeing that in primary markets. And I think markets as a whole are worried about that right now.
We can see it in just the sensitivity of bond yield reactions, but I got to think probably the worst setup for hedge funds going into this. I mean, we just learned that they had record shorts on CFTC futures for the 10-year yield. Is it possible to dissect how much of this move is about positioning, is about short covering?
I think we will find out in due time whether or not that is the case. But at this point, there is a very real sense that people want safe assets. People just want to know that their money is safe and that, you know, they're in big companies, big government debt. They don't want to take risks. And that's completely understandable with the fact that First Republic said what it said. There could be many other banks out there that are in the same position, and that's what people are worried about.
Now, I guess you could also say one of the ways to be safe is in tech. We certainly saw that during the initial turmoil, that tech outperformed. It came back a little bit, but I wonder if earnings from Microsoft, from Alphabet reinforce, hey, maybe tech still is a safety trade to some degree. Is there any validity to that?
Look, I think it was a really nice surprise at what we got yesterday, but we still have Meta and we still have Amazon this week. So we need to see what happens there. But there is big tech and then there's tech. So they are two completely separate things. You've got big tech, which doesn't necessarily rely on the sort of funding that you would get from banks like SVB. And then you've got the smaller tech, which does need that kind of funding. So for that reason, it's not quite the same story. But these are some of the biggest corporations in the world, and they do move markets. So for that reason, there is some positivity there that they do have some good earnings, but we need to see what the other two companies say first.
Yeah, a really important distinction. Dana, thank you so much for joining us this morning. That's Dana El-Baltaji, Bloomberg Managing Editor for Credit in EMEA. Now, coming up, Standard Chartered beats estimates with higher rates boosting profit. We're going to bring you our interview with CFO Andy Halford next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Standard Chartered shares have dipped despite the lender reporting its largest quarterly profit since 2014. I spoke to CFO Andy Halford, who said the bank remained, quote, very, very stable during the recent turmoil in the sector.
Top-line growth has been really strong for us, so we're up 13% on our top-line growth. We were up double digits last year, so the overall performance of the business has been fantastic. The profitability is now up at the levels we last saw back in 2015, so a long period of time since. Interest rates going up has clearly been a help in that, but also we have seen a lot of client demand as particularly the Asian markets now pull through the COVID period and start to look forwards.
Does that mean that even if the Fed, the BOE, stops hiking, that interest income margins will have peaked, or is this not the peak yet?
So last year, our interest margin was about 1.4%. We have said this year we think it will be about 1.7%, and we have said next year we think it will be about 1.75%. So we are sort of nearing a higher level, but still on the rise.
So if everything looks good, profitability is still strong, your figure of $5 billion worth of capital returns by 2024, would you say that's a conservative figure then?
Well, we need to start somewhere. So $5 billion, we are roughly halfway through excuse me, in terms of what we have announced so far. $5 billion coincidentally will be the amount that back in 2015 we raised as a rights issue, so essentially it will be handing that money back. But I'd say overall we're well on track for delivering the $5 billion.
Are you still fearful that the worst of the contagion, again, emanating from a market far away from yours, but are you fearful that perhaps that's not over yet?
There obviously have been two major issues in the sector, but actually for us as a business, we have actually seen our numbers stay incredibly solid. So our deposits have remained very, very stable throughout the period. So not that anybody is totally insulated from something going on in the sector, but I do think the fact our businesses are more based in other parts of the world. We are very spread. Our deposits are spread across many countries, many different types of client. I think actually our business model is a very robust business model for this sort of circumstance.
Well, almost, I mean, perversely, does it help you? And I'm thinking here specifically of Credit Suisse. Did you see flow that was clearly from them, clearly from their clients, especially in wealth management, fleeing Credit Suisse and coming into Standard Chartered?
I think if you look back over the last probably 6 months or so, particularly last year, we saw strong growth in our assets under management. I think some of that was probably helped by some shift away from some banks like that. So I think this will be a flight to safety. I think the bigger, more robust institutions that have been around a long time, are trusted, will be the beneficiaries of this.
In January, First Abu Dhabi Bank said it had explored a deal with Standard Chartered to buy it. Since February, it said it's no longer planning to do so. Have you had any conversations with them since? Is Standard Chartered, is the future still an independent bank?
We have had no discussion with them whatsoever. We are an independent bank. We are motoring well under our own devices. We're very pleased with our performance.
Independent from here on out. Andy Halford, Standard Chartered CFO there, on the confidence he has on their numbers, again, despite the recent banking turmoil. Now let's get over to the First Word News. With that is Leanne Gerrans. Hi, Leanne.
Hi, Danny. Renewed fighting in Khartoum is testing a fourth attempt at a nationwide ceasefire in Sudan. Smoke was seen rising from the presidential palace in the country's capital yesterday, with violence also reported in nearby cities. The UK, meanwhile, has begun evacuation of British nationals amid mounting criticism. It's been slow to react to the unfolding conflict. Now, Ed Sheeran has told jurors he would be, quote, quite an idiot to perform two songs together if copyright infringement claims against him were true. The singer's been taking the stand in a New York trial, accused of lifting melody, chord progression and harmonies from a 1970s Marvin Gaye song. Sheeran denies all the charges. US House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking an increase in the debt ceiling with spending cuts. In a rare sign of how close the vote could be, the outcome may not be known until the roll call happens. Both moderates and conservatives in McCarthy's Republican Party have expressed doubt about the plans. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. Now, coming up on the program, we're going to take a look at the man leading the French tech company Dassault Systèmes. They, of course, reported earnings today. All of that next. This is Bloomberg.
young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
From London, in Sydney, from Washington, in Tokyo. 9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Gallows is the deputy CEO today. He has been working with me for almost 20 years. He has been the CFO. He has been in charge of all brands. So he's ready. I told him, which is probably unique in many companies, I told him that he should tell me whenever he's ready, and I think this should happen soon, so I will then become the executive chairman, and he will take over. That's why I was mentioning to Anna here that probably is one of my last quarter communicating with Bloomberg, because he's going to take the lead.
Bernard Charles is there, CEO of French tech company Dassault Systèmes. Of course, maybe how long will he continue to be CEO? Right. He also has recently risen in the ranks of Bloomberg's global billionaires list. Bloomberg's Caroline Conan looked at his journey from intern to the C-suite.
From intern to billionaire, in 40 years, Bernard Charles has climbed to the top of French software giant Dassault Systèmes. Today, the chairman and CEO of the Dassault holding company's biggest business is a billionaire and one of France's highest paid executives. With a compensation package of about $36 million last year, he's not far behind some of Silicon Valley's highest paid bosses. Charles is the frontrunner to take the top spot at the Marcel Dassault family holding in the next couple of years, one of France's most influential conglomerates. Dassault's business goes back over a century. It has grown into an empire spanning aviation, media, real estate, software, vineyards, and an auction house. Investors might agree Charles's rewards are justified. Over the past 5 years, including dividends, Dassault Systèmes has been among the top 10 most profitable investments on the CAC 40. Perhaps little wonder he was named among the world's best CEOs by the Harvard Business Review in 2017.
Bloomberg's Caroline Conan there. Now, from the Medicis to the Morgans to the Charles, I guess. Now, the business of lending, trading, and investing money has long been a path to astonishing riches. In a special on the Bloomberg terminal and website today, the team took a look at the risk takers and the innovators at the cutting edge of mainstream finance and those who have become the wealthiest from doing so. Joining us now, one of Bloomberg's own risk takers and innovators, Charlie Wells. I'm going to be honest, I didn't write that introduction, but I agree with it, Charlie. I absolutely agree.
Calculated risks.
Okay, so maybe you haven't made the top of the billionaires list yet from those calculated risks. Maybe that's your problem. They need to be less calculated. But anyway, for those that did top the list, who were they?
I've got the list right here, and look, Ken Griffin coming in at number 1, wealth $35 billion, definitely beating me there, age 54. Jeff Yass, founder of Susquehanna, one of the world's most successful proprietary trading firms, wealth there, $33.1 billion, age 67. And the number 3 on our list is Changpeng Zhao, otherwise known as CZ, CEO of Binance, wealth there, $28.2 billion, age 46. So blowing by me by far.
Well, they're also older than you, so you have time to catch up. Okay, so this is the new finance rich list, right? What makes them new finance? What was the category to decipher who makes the cut?
That's a really good question. So if you type rich go on the terminal, you will see the world's richest people. These are billionaires. So are the people on this list. But what we wanted to do is sort of figure out who had made money recently, people who hadn't necessarily inherited their wealth. So we excluded people who had inherited wealth. We excluded people who had been on that rich list 10 years ago, so from 2013. We excluded people who were, say, 70 and above, or people who had retired from their businesses. And what we got was this sort of younger group of people who have made their money quickly in the past 10 years.
What does that tell us about wealth creation then?
You know, Danny, what I would say is it's all in the computer. So I don't want to sound like Derek Zoolander, but a lot of the people who have made the top of this list really made that money by being powered by computer-driven trading companies. So you think about Ken Griffin, he's got a hedge fund, but he also has Citadel Securities. That is a global market-making business. It's one of the largest in the US. You think about Jeff Yass, number 2, again, really making sort of fast decisions there. And contrast this with some of the other people who are sort of at the top of the more traditional billionaires list, people like, Warren Buffett. They make long-term bets as opposed to these people who are making bets and getting rewarded in splits of a second.
Really interesting, Charlie. Thank you so much for breaking that down for us. Charlie Wells from the Bloomberg team. Again, you can check that out both on your terminal, not turmoil, and on the web. Now, coming up, we're going to be speaking to Zeno Staub, the CEO of wealth and asset manager Vontobel. We're going to get his views on the recent banking turmoil and the report last week. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Wall Street slides as turmoil at First Republic rekindles fear of a U.S. banking crisis. But U.S. futures rebound after beats at Microsoft and Alphabet reassure investors that this year's tech rally has room to run. The company outlines their vision for AI. Plus, Standard Chartered reports its largest quarterly profit in 9 years as rising interest rates boost its bottom line. We'll hear more from our interview with the CFO. Good morning. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London, in for Francine today. Now, First Republic's disappointing earnings and potential asset sales have rekindled worries that the banking crisis is not yet over. Now, at first, the lender's earnings spooked markets. U.S. stocks dropped. And then yesterday, there was further concerns about asset disposals. We also saw Treasury yields retreating. Clearly, those fears of banking turmoil and the potential contagion effects have captured the attention of investors yet again. Well, joining us now is Zeno Staub, Chief Executive of Vontobel, who himself has to deal with some market turmoil and fallout from this. Zeno, just on that point, how concerning would it be? Again, your world is far away from regional banks in the U.S., but how concerning would it be for the financial sector as a whole if we did have another regional bank go into receivership?
First of all, we're a global investment firm, so we're only affected in protecting the wealth of our clients in navigating this crisis. Second point, I think regulators and governments have shown very, very clearly that they are very, very determined to stabilize the global financial system. And therefore, I think it's an isolated regional issue in the U.S. linked to basic mistakes in handling balance sheets, a repetition of the savings and loan crisis and the Office of Thrift Supervision failures from the 80s and the 90s, and that will be handled within the U.S. government and regulatory system. We have no doubt about that.
Are you bracing for more regulation? I know Janet Yellen has talked about this idea that the non-banking financial institutions also need a closer eye, a closer looking at.
Well, first of all, I would start with applying liquidity coverage ratios and interest rate risk regulation to all banks and not only to the top 4 global banks, which is actually something that has happened in Europe. And I think all the numbers that came in from the European banks this morning, to which I was highlighted by our team from 24 here in London, were actually robust and solid. And I think the American system has to review the decision that all the regional banks were exempt.
So there might be some overlap in perhaps the type of clients that First Republic has and yourself, you know, high net worth individuals. They also had a big wealth management business. Have you looked at if they're disposing some of that potentially? Would you be interested in making any purchases there, if so?
We're not interested in onshore wealth management acquisition in the U.S., as we think it's too highly tilted towards an advisory approach. We're a global investment firm with a strong focus of long-term diversified assets. We're in fact the largest Swiss-based SEC-registered investment advisor, and we're going to stick to that strategy.
Well, and you certainly did have an increase in AUM in the results which you reported not that long ago. How much of those, if you're able to tell, came from Credit Suisse directly?
Well, first of all, our strategy is based on our strengths and not on the weakness of our peers. Second, if we would carve out the Credit Suisse flows, we would still have beaten our 4 to 6% target. But yes, clients trust us. Clients see that we're safe, stable, long-term, family-controlled. We see inflows.
Was it mostly Swiss clients then that shift came from?
We're very happy that we keep growing across all our focus markets, but it's perhaps important to see that our focus markets are predominantly developed Western-allied markets.
So part of the issue, though, not necessarily just inflows from other turmoil, but market turmoil in general tends to not be great for holding on to wealth management clients. Has that gotten better so far in April? Has some of that turmoil subsided and maybe made clients and wealth management assets more comfortable, I suppose?
No and yes. So the uncertainty is still here. It's also very important to see that January and February were completely different to March. January and February, people anchored expectations on inflation and on exit rates of central banks, so they were willing to deploy capital. March and April so far is dominated by uncertainty, which brings people to trust us with their overall assets, but in dialogue with them, we refrain from allocating or deploying all of them to on-risk assets.
To that point, are you at a point, because I hear it with market guests, market strategists, CIOs I speak to all the time, that everybody wants to be defensive. Is that what you're hearing from clients? Are they saying, get me out of risk completely, just put me in government bonds, put me in things that I'm safe in? What does appetite look like at this moment?
We see that clients have been very robust, very resilient. There is a reluctance now on the fixed income side to actually deploy. Again, very different. January, February, we saw strong inflows, strong signals of clients to deploy capital. Now, again, they want to see more visibility on inflation, which we think actually has peaked, and central bank policies. And then, so I think that the wall of money that will be deployed is there. It got just pushed out for 2 to 3 months.
If inflation has peaked, are you concerned about an ECB that, for the most part, has kept up its hawkish language, kept up its desire to continue hiking?
Central banks always run the risk of being too lavish too long and then perhaps also err on the other side. Let's see.
Let's see. So how have you been advising your clients to prepare in the meantime if potentially the ECB makes a mistake and takes it too far?
I mean, we obviously keep clients in short duration products, which is a very strong interest right now. So keep part of the powder dry, be careful on the duration side, but look at the value that is included in some of the spreads in fixed income markets, which we find quite astonishing. But again, clients need more visibility.
How have clients, behaviors, what they've said to you, how has it changed in a post-Credit Suisse UBS combinated world? How have their attitudes changed towards the financial, towards the asset management sector?
I would say not to a very large degree. I think we should not overplay that event. First of all, Switzerland has delivered on its responsibility to create the very fast-track decision process over a weekend. Now, obviously, we understand and see that the different stakeholders will continue to criticize and to challenge part of the characteristics of that solutions. And also for Sergio and his team to sort this out, it will take years. But overall, this is not a watershed moment for the general behavior of clients towards the financial center.
There have been some concerns that it just makes a Swiss banking behemoth that's just too big, that there's not enough market competition. Are those criticisms fair?
I think you have to look at it in a very differentiated way. First of all, the political process in Switzerland is not yet finished, so there will be Swiss bodies who will look into that situation. I think on the global wealth management side, there is a plethora of options and obviously also very strong additional brands. I'm not going to mention all my most admired peers, but we are obviously also one of the alternatives that is there. Swiss retail banking is very competitive. I think there are certain segments that people will look into it. Switzerland has also a history of being very open, so the country has always been more open to global competition than some of our neighbors are to us moving into their markets. So I would say companies and clients in Switzerland will continue to have a choice, but it's in certain areas a topic that needs to be watched.
Okay, Zeno, well, thank you for helping us watch the topic. Thank you so much for coming in, joining us this morning. That's Zeno Staub, Vontobel CEO. Now, quickly, while we're on the subject of banking of First Republic, let me take you into what those shares are doing pre-market. It is a big move to the upside, but recall First Republic fell some 50% yesterday, so perhaps not completely surprising to see some nibbles around the edges on that. Now, PacWest, another regional bank, that's having an even larger gain this morning, up 20%. It had fallen 9% yesterday, so same thing, moving in the opposite direction. PacWest did say this morning that deposits are now stable after turmoil had really slammed those shares, so some positive news from that front, at least that's what they're saying. So those shares moving higher in the pre-market trade. All right, coming up, we're going to check your other stocks on the move this morning in Europe specifically, including Kering, down this morning as Gucci's sales stutter. This is Bloomberg.
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Next week, Bloomberg is live from the Milken Conference in Los Angeles. Bloomberg's all-star team will bring you the latest news and speak to the biggest names with the capital, power, and influence to change the world.
Globalization, certainly there's areas it's retreating. It isn't dead, it's just changing.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter.
Live coverage begins Monday at 10 a.m. Eastern Time on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Standard Chartered has reported its largest quarterly profit in 9 years. Rising rates help boost the London-based lender's bottom line with pre-tax profits of just $1.7 billion. I'm joined now by Bloomberg Markets Managing Editor Christine Aquino to go through all the most important stories in the UK this morning. So, Christine, starting with Standard Chartered, the results were good, maybe a tepid reaction from shares this morning, though?
Yeah, exactly, Danny. Tepid reaction from shares. I think last I looked, they were actually trending lower now, and that really just goes to show that the banking sector sentiment at the moment is not great still. You know, we saw the turmoil in March really taking a toll on investor sentiment, and that rippled across various banks, despite the fact that the actual banks that have collapsed are really quite confined to the US. And then, of course, we know Credit Suisse here in Europe, not so much really a UK story, but still they got sideswiped in that move. And so I think, you know, for banks, there's a high bar for them to kind of really impress investors and kind of reassure investors that everything is fine, especially because, you know, looking over in the US, we're still seeing issues with First Republic and the likes. And so even with the beat today, Standard Chartered just not doing enough to kind of really reassure investors that, you know, the worst is over. Not probably a story specifically related to Standard Chartered, but just more broadly a banking sector thing.
Yeah, and maybe there's those concerns too that, okay, your net interest income looks good with rates moving higher, but maybe if the BOE and the Fed are about to stop, that will have peaked. Speaking of the BOE, I got sent this story a lot yesterday, Christine, about comments Hugh Pill made. What were they? What has everyone up in an uproar?
I mean, it was essentially Hugh Pill saying that basically people in business in the UK just have to get used to the idea that they're worse off, or, you know, that they're poorer, shall we say, than they were previously. And, you know, I'm sure it struck a lot of nerves yesterday. I saw this making the rounds on Twitter and various social media as well. And it's very interesting because in the context of, you know, what we're seeing in inflation, a lot of that, of course, falls under the Bank of England's remit. And there's definitely a perception that the Bank of England has just simply not done enough to curb stubborn inflation. It's still in double digits. They keep getting shocked by just how persistent it is. And I think the other piece of this story as well is that it's not that inflation is being driven by, I mean, yes, part of it is the wages story, but it is primarily a good story. It's the price of milk, it's the price of eggs, it's the price of energy that's really driving that. And, you know, a lot of that is the Bank of England's responsibility to rein in.
Right, and it wouldn't be the first time that they've gotten some blowback. I mean, I think of Andrew Bailey saying don't ask for raises this year, those sorts of things. Now, finally, despite the fact that we have this cost of living crisis that continues on, another great story on the terminal today that there's more of an uptake in private health care in this country. What's going on there?
Well, Danny, I mean, it's no surprise, right, that we've seen the NHS really crumbling. They've been really struggling in the COVID era aftermath. And then, of course, it's been plagued by strikes as well. Doctors and nurses alike taking the streets and demanding higher pay, despite the fact that the Bank of England is discouraging them from doing that. But, and all of that really just coming to a head in terms of the services that they're able to deliver. We have seen long wait times, patients really kind of struggling to see their doctors, even for some of the most basic checkups. And so I think in this sort of era, the boom has been seen in the private healthcare industry because, you know, paying a premium does get you better service. So you get what you pay for, right? And I think also with the struggles that the NHS have been having, a lot of these private healthcare providers have started to capitalize and kind of position themselves as the alternative.
Okay, interesting. Christine, thank you very much for joining us. That's Bloomberg Markets Managing Editor Christine Aquino. Now let's get some of our top corporate stories. With the Bloomberg Business Flash is Leanne Gerrans. Leanne.
Hi, Danny. Gucci sales barely grew in the first quarter as Kering's biggest luxury brand struggled to win more shoppers. Revenue at Gucci rose 1% on a comparable basis, missing analyst estimates, while sales at the division, which includes Balenciaga and Alexander McQueen, dropped 9%. The results stand in contrast to the strong performance of rivals LVMH and Hermes. Now, Ed Sheeran has told jurors he would be, quote, quite an idiot to perform 2 songs together if the copyright infringement claims against him were actually true. The singer has been taking the stand in a New York trial accused of lifting melody, chord progression, and harmonies from a 1970s Marvin Gaye song. Sheeran denies the allegations. Apple is reportedly working on an AI-powered health coaching service and new technology for tracking emotions. Sources say it's planning to use Apple Watch data to create tailored fitness programs and iPhone algorithms to determine a user's mood from their speech and the words they do type. The move is part of a push to make health features central to Apple's product offer. Global news powered by more than 2,700 journalists and analysts in over 100 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you so much. All right, let's get a check on your stocks on the move this morning. Joe Easton from the Bloomberg's equity team has that for us. Joe, what you got?
Morning, Danny. So we got plenty of red on the screen today, as you'd imagine. So starting over in Amsterdam, we got ASM. This is the worst performer here in Europe today, down 8%. They make computers that make chips that go into smartphones and other personal devices as well. And they are seeing a slowdown in projects, companies cutting back on their capex spending, and that is hitting that stock. That's the worst drop in almost 3 years. Meanwhile, we've also got the Gucci owner Kering, which Leanne mentioned there. That down around 2% over in Paris. The company today warning that quite a few people in the US that they describe as aspirational buyers, they're cutting back due to the cost of living crisis, and that is countering a bit of the strength that they've seen in China as well, and really in stark contrast to LVMH that have, of course, been rallying in recent weeks. Meanwhile, in the UK, we've got GlaxoSmithKline, this one down 1.5%. Now, the headlines were pretty strong on the top line numbers from GSK. However, some of their specific drugs have missed expectations, specifically in immunotherapy and also asthma. So analysts out today saying that the sales could be weaker in those key drugs, and that's what's hitting that stock today. As I say, down 1.4% in London. Meanwhile, we've got Persimmon finally giving us a bit of green on the screen, up 5%. This is the UK home builder. They are seeing a bit of an uptick in their home sales. Finally, sales were up around 0.8% according to the firm, and that was surprising. They were expecting to decline as well, and that report is actually lifting a whole load of peers, including Taylor Wimpey, Bellwoe, and Crest Nicholson as well in London. The home builders getting a boost. That one, the best performer on the FTSE 100 today.
Okay, Joe, thank you for the roundup with the overall index down about 0.6%. Joe Easton there from our equities team. Coming up, is Elon Musk a visionary for the car industry or steering Tesla into trouble? We'll discuss the autos biz next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. There's a raging debate in the EV space about Tesla's prospects. Some see Elon Musk as a visionary for the auto industry, and others think he is steering Tesla into trouble. That's a subject of today's Big Take, NI Big Take Go on the terminal for that. Let's bring in the author behind it, Bloomberg's car czar, Craig Trudell, for the bull and bear case on the company. So Craig, you lay this all out really well in your piece. What are the fault lines here? What is the dividing line of people say, okay, I don't like what's happening with Tesla? Of course, a lot of headlines last week about cutting prices.
Yeah, I don't think, it's simple to sort of sum this up as, Musk doing this sort of on his own volition, right? You don't cut the price of your best-selling model by 29% in roughly 3 months from a position of strength, right? That being said, this is not a case of the sort of sky falling and Tesla falling apart. The Model Y might end up being the best-selling vehicle in the world this year. So it's a really complicated story. I think it is the case that Tesla's vehicles got really expensive in the midst of all of these supply chain issues, and these were, of course, industry-wide problems of everybody not being able to make as many cars as they would have liked and as they had demand for. I think what we've seen with Tesla is a whole lot of production capacity come online very quickly, right. And that coinciding with this normalization of the supply chain and leading to this really drastic change in price.
Craig, less than a minute here, but is this going to start a pricing war with competitors? Is that the net effect of this?
I think there will be some cases of say, electric pickups where, even if the Tesla Cybertruck does come on, arrive on time, it will probably be lower volume. Maybe we'll see less competition in, say, the F-150 Lightning. But even within Ford's own lineup, you've already seen the Mustang Mach-E, which competes more head-on with the Model Y. They've had to take pricing of that down. So I think it will be in some spots, we'll see a lot more activity and a lot more competition. In other spots where Tesla isn't playing, maybe less pressure.
Okay, yeah, I mean, we certainly saw impact on shares last week. Craig Trudell there after a very busy week for him in the autos industry. All right, that's it for Bloomberg Surveillance Early Edition. Tech continues to outperform after strong earnings. More earnings from Meta and others on deck. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a
price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Microsoft magnificently positioned. So is Google. So is Amazon.
I think tech outperforming that could be forward expectations and forward easing expectations and coming through.
The resiliency you've seen in earnings out of the index, so to speak, is because these businesses have magnificent income statement flexibility.
As a result, we're seeing our model sort of shift more towards technology.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Big tech surprises. Shares of Alphabet and Microsoft are higher after quarterly results are better than expected. Regional banks hope to rebound. First Republic may sell up to $100 billion in assets, while PacWest says deposits are now stable. And electric vehicle sales are expected to soar again this year after a record-breaking 2022. We'll discuss the global EV outlook with the Executive Director of the International Energy Agency, Fatih Birol. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller over in New York. And Matt, we seem to be caught between two themes on either side of the Atlantic. Europe still reflecting the nervousness around banks and perhaps a little bit of domestically generated nervousness on earnings here today in this time zone. But in terms of the US picture, you're looking ahead, looking at futures that reflect positivity on tech.
Yeah, I mean, earnings look pretty good from our perspective, unless you're looking at the banks, right? We saw First Republic come out yesterday with earnings that and deposit flows that really disappointed investors, then a conference call that disappointed investors further, then the possibility of an asset sale plan was reported by Bloomberg that disappointed investors even further, and First Republic ended the day down 50% after it's already lost so much of its value. And we saw a number of stocks yesterday on the S&P and the cash trade absolutely decimated, and that broke us out of this tight range in which we've been trading. We haven't seen a move up or down more than 1% for all of April until yesterday. We were off 1.6% on the S&P. We now see futures, though, higher this morning, so maybe some investors think that move was overdone. Maybe there's positive expectations for earnings to come out today. Investors are also letting go of U.S. government debt. So the 10-year yield, although it had come down to a pretty low place, is now moving just slightly higher right now at a little over 340. The Bloomberg U.S. Dollar Index is lower, so that signals investors aren't worried enough to seek the safety of the greenback. That tends to be what they do, and you see the dollar losing ground against the euro, against the pound, against the yen. So wherever you look, a weaker dollar this morning, and against Bitcoin as well, I should point out. Up 2.8%. We had fallen down to 27 and change yesterday. Now we're back up to 28,767. So you didn't see the negative correlation with the cash trade. You see a positive correlation with futures today. Take a look at Asian markets. We see a little bit of a mixed trade there, at least in terms of what's going on in Hong Kong versus Tokyo. The broader MSCI Asia Pacific was little changed, but the Hang Seng in Hong Kong up 0.7%. The Nikkei closed down 0.7%, and they're mirror images of each other in terms of the percentage moves. I will just quickly mention that Nomura Holdings came out with profit that was that dropped by 3/4 in the quarter compared to the same quarter last year. They had a drop in fixed income trading due to the volatility that we saw at the end of the first quarter, but it's a pretty light move, only 1%. So it looks like there is banking nervousness around the globe, and but the problems at First Republic are pretty endemic to First Republic and not, I think, showing signs of a wider crisis in the banking industry.
Yeah, and what is also interesting, Matt, about that is that, yes, Europe is down and the bank sector is down, reflecting weakness on Wall Street yesterday, but the bank sector isn't down particularly more than any other. So it isn't really a focus on banks here in Europe. It is maybe that negative sentiment coming from the United States, but not concern about banks specifically in Europe. And certainly we saw last time around, back in March, we remember well the way that nervousness transmitted across the Atlantic. So this time looks a little bit different, perhaps. We are seeing, though, some more European-generated nervousness around specific earnings reports. They certainly haven't all been rosy this morning, but there have been some bright spots. Generally, though, we are weaker, down by around 0.5% on the CAC 40 and the Xetra DAX in Paris and in Frankfurt. Let's have a look at some of the movers then, some of the individual names that are in focus today. I know we've got to focus on GSK. This is the UK-based, of course, pharmaceutical giant. The stock is down by 1.3%. The numbers didn't look so bad, but maybe there was some conservative estimates in there. That's certainly one of the reactions from analysts. Kering, the luxury goods company, one of them, based over in well, European-based, of course, and this business is down by more than 2%. The expectations were so high, given what we'd heard from others in the sector, the likes of LVMH and Hermes. We didn't hear the same from Gucci, which is owned by Kering, and so as a result, the stock sells off. And just thinking about where we're not seeing negativity, and it isn't everywhere, we heard from the CEO of Telia, which is a telecoms business in Scandinavia. They're saying they're not seeing any signs of recession in any of the markets that they operate in, which I thought in itself was interesting. That stock up by 5.6%. And this is the other side of, Matt, what you were talking about with the weakness in the dollar. So even if we're weaker on stocks, there does seem to be room for risk appetite because we see weakness in the dollar and we see, yes, the market buying euros, buying the pound. Here's the euro move back over 110.
All right, interesting stuff. Dollar weakness definitely across all of its trading partners, major trading partners today. Let's get back, though, to the big tech earnings and kind of the war in AI. Microsoft third quarter profit and sales came in better than expected, boosted by resilient cloud computing demand. And Alphabet's results also beat estimates as its cloud unit turned a profit for the first time. On the earnings call, Alphabet's CEO spoke about the strength in that company's Google search business.
The fundamental drivers here are people are looking for relevant information, and in commercial categories, they find ads to be highly relevant and valuable. All those dynamics, I think, which have long served us well, remain, and as I said, we'll be iterating and testing as we go, and I feel comfortable we'll be able to drive innovation here like we've always done.
Joining us now for more is Bloomberg Intelligence analyst Matt Bloxham. So I find this so interesting that Google and Microsoft are now competing on both search and cloud. Obviously, Microsoft had real strength in the cloud market. Google has dominance in the search market, but is that set to maybe change?
Potentially so, and I guess if there's going to be a big change, it's likely to be in the search advertising business, where Google dominates with 93% share of the global market versus Microsoft's 3% with Bing. It's such a huge market that just a small amount of share gain for Microsoft on the back of their AI investments could really add a lot to their revenue and profit. Clearly, Google has been in the cloud business for some time. It's growing some momentum now. They recorded a profit in that business for the first time ever, but they're a long way behind both Microsoft and Amazon on cloud. So there's still a lot of work for them to do there to be considered to be a real big player in cloud for enterprise.
Yeah, Matt, good morning. What else did you take away from this set of earnings? We've got confirmation perhaps that Google still is the search giant that we've known it as, and there has been this big focus on AI.
Yeah, I think, for a lot of people, it was this resilience in enterprise spending on cloud. My colleague Anurag Rana, kind of suggesting that maybe the worst is over in terms of the enterprise spending slump. We'll have to see if that plays out, but I think people will take optimism from both sets of results, and that's obviously a good read across into Amazon later this week. And I think, although there's resilience there in Google's ad business, I think we're getting more mixed messages from the broader ads ecosystem. And I think we're going to see a more mixed set of results from the likes of Meta and Snap later this week, because I think Google's search business is the default that brands use. They know it, they trust it, rely on it. The return on investment's really good, right. Perhaps less so for Meta or Snap.
Well, and for consumers, I mean, Matt, what's your experience? Have you used Microsoft's new AI-assisted Bing?
I've played around with it, and I've been waiting to get through the wait list on Google Bard, so I'll play with that one too. I mean, I think what they said, 100 million or so active daily users on that platform. And I think a lot of people are just experimenting with it. They're curious, wondering what it does. Whether it becomes what people use as their default to search for things is a much bigger question. Obviously, people are so used to using Google to search for things. I think it's going to take a lot for people's behaviors to change.
All right, very interesting stuff, Matt. Thanks so much for joining us this morning. Matt Bloxham there of Bloomberg Intelligence. Now let's get to the banking story. First Republic Bank is considering selling up to $100 billion in assets. This comes as the beleaguered lender attempts to rescue itself from the turmoil that engulfed the industry last month. Bloomberg's Valerie Teitel joins us now for more. So, Valerie, is this about stopping, the FDIC and other regulators from putting First Republic into receivership first?
Well, look, First Republic has really failed to prevent the deposit outflows from stopping, and it's causing a lot of problems for its balance sheet. It's definitely taken the eye of the FDIC, and now there's reporting that they're looking to offload up to $100 billion of their assets. Now, if you put that into context, their total assets near around $230 billion, but their loan book is $170. So it would be a sizable chunk of their loan book they're looking to offload. They hope to offload these above market value by offering potential sweeteners to buyers, such as warrants or preferred equity. That's a very similar strategy that was used in 2008, which helps strengthen First Republic's balance sheet and then offers a potential upside to those buyers. But the problem is now, Matt, that the First Republic is not the only bank out there looking to divest loans. Other regional banks are considering doing the same, and the FDIC is also divesting the loans they still sit on. And clearly, there's just not that many out there who can buy loan books of this size. And the market worry is that ultimately, if a buyer isn't found, these loans will end up on the FDIC's balance sheet as a liability and at the end to the U.S. taxpayer.
Okay, an interesting, certainly a fascinating story, one that has continued to grip markets and reminded us of what we were worried about in March and how it hasn't all completely gone away. And given that, Valerie, did this then have an impact on Fed pricing, on thinking about how many more interest rate hikes we'll get from the Fed?
Look, the Fed meets next Wednesday, and I think this takes completely off the table that we get a hawkish hike from the Fed. The probability even for a hike for next week dropped to 80%. And then if you look at how many cuts are priced into the curve, we're pricing now more cuts out to June next year than we were at any time during the banking crisis back in March. So, the conclusion is that this could be a long slog of a banking crisis, and a hawkish Fed is something we're not likely to see next Wednesday.
All right, Valerie, thanks very much. Valerie Teisel there talking about the destruction of First Republic value and what they plan on doing about it. Amid the resurgent banking angst, rattled stock markets may have to live without a key source of buying power. That's the warning from Goldman Sachs' Scott Rubner. His data shows that quants are running out of ammo for buying stocks, and they're already pretty long. Bloomberg Markets reporter Justina Lee joins us now with the details. So, who are these quants that we're talking about? Which specific strategies, and why are they out of ammo when there's, so much cash on the sidelines, right?
Yeah, I mean, Goldman here is really focused on what we call commodity trading advisors, which are mostly trend followers, and volatility control funds. And if I can simplify entirely, I guess the basic way to think about what trend followers do is, if stocks are rising for a period of time, they're buying and vice versa. And for volatility control funds, they're basically buying assets where the volatility is falling. And that kind of explains why, as Goldman estimates, these groups have been buying $170 billion worth of stocks over the past month, which took their exposure to the highest since early 2022. And now, so that's already a pretty different picture from what fundamental managers might be doing. And what Goldman is saying here is that if stocks do keep rallying, this group doesn't really have a lot of ammo left to keep buying. But on the other hand, if stocks do start to reverse, then they have a lot of room to take down their exposure.
Okay, so does this suggest then that stocks would be weaker because quants, can't keep on buying forever? It seems to fly in the face of what we heard about the hedge fund community, which maybe have been putting shorts on stocks. We covered that story a little earlier on this week.
Yeah, right, exactly. Because a lot of fundamental analysts are seeing, issues in the economy. They're worried about credit crunch, recessionary risk, and of course, bank risk coming back again. So there was a school of thought that perhaps we have seen stock markets recover so well after Silicon Valley Bank collapse because quants have been doing this. Now, this is a slightly controversial view. Not everyone agrees with it, but I think the bottom line from Goldman's warning here is that if you believe that this group was the support for the market, I mean, that's going to rapidly dissipate.
All right, Justina, thanks very much. Really interesting stuff. Justina Lee there talking about the Goldman Sachs deal on rules-based hedge funds that have bought and may sell. Let's talk about some of the pre-market movers. PacWest Bancorp is another one often mentioned in the same sentence as First Republic. It had a rough day yesterday, and we're seeing a bit of a bounce today, up 18% in the pre-market to 12.12. So watch PacWest. As I said, maybe First Republic's problems are solely those of First Republic and not issues across the industry. PacWest seems to have done a better job of stemming outflows. In terms of the earnings that we got yesterday from Microsoft and Google, we do see Microsoft shares moving up considerably in the pre-market. Remember, those earnings came after the bell, so you can watch Alphabet, you can watch Microsoft this morning. For its part, Satya Nadella's company is up 7.6% in the pre-market after saying that investors are really excited about the AI-powered version of Bing. Maybe the first time consumers have been excited about Bing in forever. NVIDIA is up today after some analysts raised the stock to a buy, and also the chip maker said that it's got new software that helps to keep AI chatbots on track. So it's only a 2.2% gain, but it's in the vein of AI, so investors are going to be watching this, maybe trading it heavily today. And then a deal that I've been following for a couple days, a potential deal that the Target says isn't really a potential deal. Getty Images down another 5% to $6 in the pre-market. It says that Trillium Capital's $4 billion takeover bid is not sufficiently credible. Remember, Trillium had been saying Getty needs to sell itself for $12 a share. Then Trillium came in and made a hostile bid for $10 a share. But Getty Images, of course, is majority controlled by the Getty family, which doesn't want to sell anyway. So what are you going to do about it? As a result, other investors are left with shares that are worth less. Anna?
Okay, so those are lots of stocks to keep an eye on pre-market. Coming up on the program, we'll talk to Madison Fowler, JP Morgan Private Bank Global Investment Strategist, get perspective on the markets. We'll also have a conversation about the growth of electric vehicles and what this means for the other energy markets. The IEA Executive Director, Fatih Birol, on the global outlook for electric vehicles and much beyond. Plus, the new finance rich list. We'll take a look at some of the risk takers and innovators representing a new era of wealth. This is Bloomberg.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards out in London. And I've got a chart that represents, in some ways, the credibility of the Federal Reserve, right? Jerome Powell continues to tell us that he and the Fed are not going to cut rates in 2023. In fact, not until they see inflation down much closer to the 2% level that they need to see it. And for a while, it looked like the market believed him. This is the probability of Fed rate cuts over the next 12 months. Now it looks like the market doesn't believe him anymore. They expect the Fed to cut rates by 170 basis points over the next 12 months. Joining us is Dana Al-Baltaji, Bloomberg Managing Editor for Credit, to tell us, Dana, what's your take on this chart on the Fed credibility, especially amid banking turmoil that seems to have, peeped up again?
I think it's important to note that the narrative has shifted over the last few weeks. We are starting to see economic data that is worrying and that is allowing people to even imagine a time when the Fed would cut. That's why that narrative is really taking hold. We're seeing job cuts, we're seeing earnings that aren't very encouraging, of course, excluding what happened yesterday. And so for that reason, the possibility of Fed cuts is becoming more and more a reality. I think at some point, investors are weighing whether or not the Fed and other central banks will continue to raise rates even if inflation is high when there is a recession out there.
Okay, good morning to you, Dana. So we're worrying about economic data. We're clearly worrying about the banking sector, getting a reminder on many fronts that we maybe stopped worrying about the banking sector a little too early. But then on the other side, we're getting these numbers from big tech, which are pleasing in some sense to the markets. And certainly NASDAQ futures up 1.3%, reversing some of yesterday's nervousness. What does that tell us?
So look, big tech, I think we are talking about some of the biggest companies on the planet. These guys, they have a completely different measurements. You know, their advertising revenue and the way that they make money isn't the same as the way other companies make money. These guys have a completely different model, but also they don't have a funding squeeze. Other companies are facing problems when it comes to funding, and for that reason, yes, you can be completely positive about the earnings that we saw yesterday, but that doesn't necessarily mean that the economy and other companies are okay. We are seeing in the primary space that the cost of money is super high, and a lot of companies can't afford it.
Okay, Dana, thank you very much. Dana Albertaggi joining us there from here at Bloomberg, of course, bringing us the angle, I suppose, the slant from the credit markets as well, adding that in. For more market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal for the Markets Live blog. This is Bloomberg.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question its industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Keeping you up to date with news from around the world, here's the first word. House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking a debt ceiling increase to spending cuts. Still, The measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in a case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in the space. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Big tech surprises. Shares of Alphabet and Microsoft are higher after quarterly results are better than expected. Regional banks hope to rebound. First Republic may sell up to $100 billion in assets, while PacWest says deposits are now stable. And electric vehicle sales are expected to soar again this year after a record-breaking 2022. We'll discuss the global EV outlook with the Executive Director of the International Energy Agency, Fatih Birol. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it'll be interesting to see through the US session whether this positivity around tech continues to outweigh the nervousness that we saw so dominate the thinking yesterday, which was around the banks.
Yeah, I mean, it's exciting again, right? We have real movement in markets yesterday to the downside. Today we see futures moving to the upside, not obviously outweighing the drop that we saw in the S&P 500, but there's so much going on in tech, in banking, in politics, in culture, dare I say. S&P futures are right now about 0.4% as investors are optimistic about earnings that we're expecting to come out today. And, of course, what happened after the bell yesterday with the big tech heavyweights, Microsoft and Google, both beating earnings expectations. The U.S. 10-year yield is rising a little bit as investors let go of some of that paper. It's not a huge move. Right now we're at 340, but you know we've been over 350 some of this week, so that has come down substantially as I guess that's a kind of a tailwind to stocks because it's less competition for what you could get yielding from those shares. And the Bloomberg Dollar Index is also down. That's also good for stocks. It means investors aren't running for fear into the greenback globally, and that a lot of assets are worth more in dollar-denominated terms. Bitcoin, for example, is one of those assets. Right now, $28,817. So getting closer and closer back to the $30,000 level as the Bloomberg Dollar Index falls against everything else. The euro, it's down against the pound, it's down against the yen. In terms of market movers, there are a lot of them today. PacWest is one that has a big bounce to the upside on investor bets that the problems at First Republic are only problems with First Republic and not with the rest of the banking industry. The deposit outflows that you see at FRC are not the kind that you see at PacWest. Microsoft beat expectations and has investors really excited about the AI-powered version of its Bing search engine. Google obviously dominates in search with 90% of market share, and the last figures I saw for Bing were like 6.7%, but that could change. On the other hand, Google did really well in cloud, which is where Microsoft kind of dominates. NVIDIA also being driven by the AI trade today. It says it has software that allows the AI chatbots or keeps AI chatbots on the rails. I think my boss wishes we had software like that for me. And then you see Getty Images right now down 5% to $6 even. Getty Images is like 80% owned by the Getty family and friends. So they decide what happens with this company. However, Trillium, which also owns a stake, has said it wants to buy Getty Images for $10 a share. It had previously urged Getty to sell for about $12 a share, but there's really nothing you can do if you don't control the 80% majority. So as a result, those shares have continued to fall and now are down more in the pre-market. Anna?
Well, let me tell you what's going on here in Europe then, and keep things on the rails, Matt. We've got stocks here in Europe down by 0.7%. And really, it is a little bit of the sentiment of yesterday on Wall Street, but some of it's homegrown in Europe as well. Whereas technology futures in the US are going higher, tech is an area of weakness today for Europe because of the reporting season here. It's a very different kind of tech, obviously. And we don't see all the negativity centered on the banking sector today as we might have done in previous periods of concern around banking globally. So that's where we are overall. GlaxoSmithKline down by 1.2%. The numbers themselves not that bad. Some analysts, though, suggesting there had been a higher expectation on guidance, so maybe that was a little disappointing for some. And Kering, the luxury goods business, owner of Gucci, of course, the stock down 2.3%, a victim of the competition, a victim of the expectations following the results from the competition. We heard from LVMH, heard from Hermes. Both of those made it look easy to make big money in these markets, and Kering, as a result, the stock moves a little lower on its numbers. The euro is up by 0.7% this morning, Matt, and this was really the other side of the trade you mentioned earlier. We are seeing dollar weakness in keeping with that rally that we're seeing in stocks stateside, and the fact that we saw a lot of haven seeking yesterday, so a lot of money going into the dollar yesterday, some of it coming out today, and so the euro benefits the pound and a host of other currencies as well.
All right, very interesting FX trade there. Let's get over to Madison Fowler right now, JP Morgan Private Bank Global Investment Strategist. And Madison, just quickly on the banks, right? We've seen turmoil that freaked us out in March and then it kind of subsided. April, there was almost no way to break out of, it seemed, this tight trading range they were in. Now, First Republic has kind of blown that out of the water, but is it just an FRC issue and not a broader banking issue?
Sure. Thank you so much for having me. And I think what we're seeing there is just some continued jitters around what are the ripple effects of this concern around banking confidence really going to look like. But I do think it's important to separate some of the banks that have been struggling and then also the banking sector as a whole. And so I think on that latter point, what we've really been seeing is that from a broad bank perspective across both regional banks at large and also larger money center banks, bank earnings have actually been quite solid. Deposit flows have steadied quite a bit, and we've also seen bank borrowing from the Fed also start to ease as well. And so from my perspective, I don't think that this is really a crisis of confidence, but I do think it's likely that we continue to see some jitters, especially around some of these names.
Yeah, Madison, good morning. It'll be really interesting to see how frequently we go back to being worried about the banking sector in amidst all the other news flow. And some of that other news flow takes us higher today in terms of risk sentiment. So, NASDAQ futures up by 1.2% because of the strong earnings story out of tech names. I mean, tech had such a tough 2022. It's already had a good year to date. What is left, do you think? What comes next for the tech space?
Sure. So I think when we first think about the performance that we've seen so far, again, as you mentioned, we had a really tough 2022. And then in addition to that, I think a lot of what surprised us this year is just those aggressive cost-cutting pressures that have really, I think, gone to ease margins. And in addition to that, you are seeing some strong earnings come out of that as well. I think moving forward, and what we especially saw during that episode of bank confidence being challenged, is that people really thought of tech as kind of a safe haven in the port, and they really resonated with these higher quality names that have more stable and consistent cash flows. And so I think when growth starts to become even more scarce as we experience what higher interest rates ultimately mean in the economy, that I think rally for mega cap tech can probably go a little bit further. But I do think as the interest rate environment grows more challenged, as economic growth starts to slow, that it's possible that over the medium term, so think over the next 3 to 5 years, some more interesting opportunities in the mid to smaller cap space, I think.
Okay, that'll be something to watch. Yeah, Matt Bloxham was talking about enterprise spending, whether that's bottomed out or not. We will watch that. Where does that leave conversations around Europe versus the US? Because tech's had a good 2023. Europe was having a pretty good 2023, in particular luxury names, for example, especially when banks in the US were under pressure. Does Europe's outperformance, is that a theme for the year, or is that gone?
Sure. So I think there's a little bit further to go with that. At some point, it might make sense to take profits, but I don't think that we're there just yet. When I think about relative economic growth, Europe looks to be in a much better place. We don't anticipate a recession in Europe this year, whereas we do for the U.S. Relative earnings expectations also look better for Europe. In addition, when you I think add in the valuation component as well, Europe is still trading at a 25% discount to the U.S., which is wider than that 20% average. And so I do think that there's still room to go there, and we're really looking into those areas like national champions of their industries. We're looking at semiconductors, oil and gas companies that again have those strong cash flows, and also segments of the luxury sector.
What is the data? What are the data points? What are the events that you're going to be watching closely, Madison? Obviously, we have some data coming out this week, and then the Fed meeting next week.
Sure. So I think we're getting a lot of inflation data over the course of the next few days, especially in the U.S. and also in Europe. And I think that's also really going to set up those Fed and those ECB meetings that we're also going to have next week. So for the Fed, we think that, given the fact that inflation is, slowing but still elevated, the Fed probably hikes once more next week. But when it comes to the ECB, inflation's in a different place. It's still quite high. We saw core inflation hit a record the last print that we had. And so I think as we're watching, the prints that come out over the course of the next few days, the ECB is likely to be quite data dependent heading into this meeting. And the debate, I think, is quite, ripe around whether that's 25 or 50 basis points for the ECB next week.
Madison, thank you very much. Madison Fowler of JP Morgan Private Bank, thank you for joining us. Coming up on the program, we'll talk energy and the future of transportation. The IEA Executive Director, Fatih Birol, will be with us to talk about the outlook for global electric vehicles, what that means for energy markets. This is Bloomberg.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, almost 1 in 5 cars sold worldwide this year will be electric, either fully electric or a plug-in hybrid electric vehicle. That, according to a new report by the International Energy Agency. The shift to EV is set to have major implications for the energy industry and infrastructure. Joining us to discuss that is Fatih Birol, Executive Director at the IEA. Fatih, you put out a report, the IEA put out a report today that's absolutely fascinating in terms, I think, of the swiftness of the EV pickup globally. First of all, are you concerned that this is going to have a detrimental effect on the energy infrastructure? Can our grids really take this many electric vehicles trying to charge up?
Yes, you are right. The penetration is very fast and very big. In all 3 large car markets in the United States, in Europe, and in China. China is the leader, and in China, in Europe, we see that the charging stations infrastructure is built by day, and they are keeping up with the pace of electric car industry. Let me give you just 2 numbers to show you how big the penetration of electric cars is. 2019, only 4 years ago, 2% of all the cars sold in the world was electric car. So 2% in 2019. And this year, about 20%. Every 5th car would be an electric car sold in the world. And more impressive, I believe, 2030, which is tomorrow, in US, China, Europe, 3 largest car markets in the world, 60% of all the cars sold will be an electric car. 60%, 3 largest car markets. And this will have implications for the oil industry, for the electric grids, and beyond that.
I mean, it's massive growth in a percentage of new car sales. I think it's still a pretty small amount in terms of the total global vehicle fleet. But you mentioned, the implications this could have for the energy, makeup. What implications does this have for OPEC, for U.S. energy producers, for shale producers? I mean, everyone, you included, has been calling on energy oil producers to boost supply. Do they really need it if we're going to be all buying electric vehicles?
So oil is not only consumed by the cars. The road transportation makes about 40% of the total oil consumption. There is also a petrochemical industry, there is aviation, we need oil for that. But road transportation, namely cars, buses and trucks, they have the lion's share. So when I look at the electric cars and what is happening in the buses and trucks, I can tell you that the oil demand dynamics of the oil industry will be a bit different than many stakeholders hope to see in the oil markets, because they'll be much lower, especially for gasoline and diesel. The demand will be much weaker. And if the oil producers try to push the prices up, oil prices, this will only accelerate the electric cars penetration.
Okay, and in that context, Fatih, good morning. I wanted to ask you about something more about the near term, a bit more short term in terms of where we are on prices. Around the time that OPEC Plus cut production, we saw a spike up in oil prices, but now that's come back down again, so a few weeks ago. Do you still think, though, that it was a mistake for OPEC Plus to cut production because of what you described there, that it will speed up the transition away from this type of energy?
I think they have to be very careful because higher energy prices mean, and which is what those countries wanted to see, a weaker global economy, especially weaker economy in the emerging countries, and B, it will give an additional boost to clean energy transition around the world, including electric cars. So their short-term interests vis-a-vis their medium-term interests is here in contradiction. They have to make up their mind well.
Okay.
But what I believe, the global economy is in a very fragile stage. To see higher oil prices and upward pressure on inflation is the last thing that we want to see.
Okay, and with a focus on production and supply to the markets then, Fatih, can I ask you about Sudan? The United Nations is warning of a spiraling crisis there. Aside from the obvious humanitarian concerns, are you also worried about whether supply from Sudan and also South Sudan, which relies on transit through its neighbor, whether we will continue to see all the supply that we're used to from Sudan?
We are following it very closely. For the time being, there is not a major risk. But if the tensions continue, we may see some disruptions there. So this will be another headache for the oil markets.
Fatih, thank you very much. Thank you for joining us. Really good to get the details of your report and to talk about where we are on markets. Fatih Birol, the IEA Executive Director, joining us there from Paris. Coming up on the programme, the new finance rich list. We'll dive into some of the risk takers and innovators representing a new era of wealth. This is Bloomberg.
Did art
conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, a look at what's ahead today. At 8 a.m. Eastern Time, ECB Vice President Luis de Guindos is scheduled to speak at the Delphi Economic Forum in Greece. That's followed by data on U.S. wholesale inventories, or inventories for you, Anna, and durable goods at 8:30 a.m. Before the U.S. market open, we'll get earnings from Boeing, and then after the bell, Meta reports, that is, of course, Facebook. The company is forecast to return to growth after 4 quarters of decline. So we continue to have a very exciting docket for today, and I'm looking forward to it.
Yes, I'm glad. I'm glad that you're looking forward to the continued focus on tech. NASDAQ futures up by 1.2%. Now, let's talk about, wealth, shall we? In the past few years, the fortunes of the wealthy have only become bigger. The largest share of the riches goes to the risk takers and innovators who are comfortable at the cutting edge of mainstream finance. Bloomberg's Charlie Wells joins us now for a look at a new finance rich list that Bloomberg has put together. So, Charlie, who made the top list then?
Yeah, Anna, so they're newer and they're more recent. And at the top is Ken Griffin, founder and chief executive of Citadel and Citadel Securities. We've got his wealth at $35 billion, age 54. Number 2 is Jeff Yass, founder of Susquehanna International. Wealth there, $33.1 billion, age 67. Rounding out at number 3 is Changpeng Zhao, CEO of Binance, the crypto exchange. His wealth, $28.2 billion, and age 46. So this is making my bank account seem very small.
What's the methodology here? Because there are no women, for example, on the list. So I'm wondering, how do we pick these new rich people? A lot of them are, old rich people.
Yeah, Matt, that's a really important question, and it is very unfortunate not to see women on this list. Hopefully they will be there in the future. But what we basically did was on the Bloomberg terminal, if you type Rich Go, you can see a list of the world's wealthiest people. But we wanted to figure out who had been making money over the past decade or so, who has entered that list. So we filtered out people who had been on the list before 2013. We filtered out people who had largely inherited their wealth, people who are over the age of 70 and who have retired. So what we got there was this list, topped by Ken Griffin, number 2, Jeff Yass.
Okay, and it's interesting, isn't it, the way that people are making money in different ways, I suppose, to be really sort of obvious about it. This isn't about it's not about being Buffett or Schwartzman maybe, and long-term patient capital. It's not about that. I'm not sure if that's a good or a bad thing, but it's more about technology-driven traders and quants and that sort of area.
Fast money.
It's about It's about the computers, yeah. So being able to leverage technology to make really quick decisions. So, there are some hedge funds on this list that do make some of those longer term bets. But what we really saw were people like Griffin, who of course is Citadel Securities, one of the largest market makers in the world, really being able to have that information and make calls really quickly and able to make money off of that.
Okay, Charlie, thank you very much. Charlie Wells joining us there with the latest on this new finance rich list. Matt, we didn't make it.
No, we didn't. I'm more of a buy and hold kind of person, Anna.
I'm not sure we were in contention.
I'm also older, I noticed, than a lot of people on the list. It starts to make me feel a little bit uncomfortable. I don't know what I've done wrong.
That is it for Early Edition. Surveillance is up ahead. They'll be hearing from David Rubenstein of the Carlyle Group. No doubt a fascinating conversation there. They'll continue to cover the tech earnings stories as well. Of course, we've heard from Microsoft. We heard from Alphabet. We'll hear from other big names within the tech sector, though, as we move through this week. They'll keep you across the bank stories as well, as we've continued to see the way that the banking sector, regional banks in particular, can suddenly push the markets around just a little bit, as we saw yesterday. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
We're still in a slower growth environment.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
I think tech outperforming, that could be, forward expectations.
Microsoft's magnificently positioned. So is Google. So is Amazon. So is Meta.
Apple, Google, Amazon. I think these are stocks that could be up 15-20% for the rest of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I think it's fair to say the tech bulls are in the driving seat this morning. Live from New York City this morning, Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Equity futures positive a third of 1% on the S&P 500, but check out big tech with some big results after the close yesterday evening. Microsoft this morning in the pre-market, Tom, higher by 8%.
It's the way they were higher. It was really, really something. Charles Cantor there in our opening with Neuberger Berman really sounding it up, and he maybe had the best day of anyone. Yesterday. It was game-changing. You see it within the market today with futures up 12, John, and it really says, what do we do to get through this week and get onto Apple on May 4th after the Fed?
It's a beat on the top and bottom line for Microsoft, Lisa, and then a soothing earnings call from Satya Nadella talking up the generational shift that we're about to see in search.
Well, I love that you say soothing because it's what everybody wanted to hear. This is the new thing. Open artificial intelligence will change your lives. It will make us work less, be more efficient. It will make us rich. It'll be fantastic. And they said this is really going to be a game changer. Google was like, we've seen these things before. Those shares are now up by 1% and Microsoft up by more than 8%. There you go.
Too much happy talk. Too much happy talk. Can we get to the banks? First Republic chopped in half yesterday. That's the reality of the moment, isn't it? You've got this big weighting on the index, big tech, getting it done. And then you've got this worry in the financials captured, Tom, by First Republic.
I was captured yesterday afternoon like I was the day Bear Stearns went under, watching every tick of it slide from 9 down to an 8 level, even a 7 print, a little bit up this morning. I went back and forth on Twitter this morning with Dr. El-Arian, and to me, it is the El-Arian field of game theory right now. And I'm suggesting the institutions, including FDIC, look at this as a discrete bank issue and not something that has contagion to other banks. I'm just guessing that.
The latest news in the last 24 hours off the back of all of this, and I think there's a lot of speculation out there at the moment, Tom. At least that they could be selling up to $100 billion in assets. This is going to be painful if they go in that direction.
And the bigger question here is this just a First Republic issue and an SVB kind of issue, or is this a broader issue? And we saw PacWest report earnings after the bell that were actually stable. The stabilization narrative comes back. Those shares popping. This is a muddle. It is an economic muddle. And at what point are stock traders saying the economic muddle is Goldilocks?
I'm in silence because we got to wait for the data, including economic data today. The muddle here is less, I think, a muddle, but many different narratives. You can choose your narrative. I mean, that's all there is to it. I guess I'm not surprised by the tech dominance that we saw today and what we're going to see. One thing yesterday, John, that struck me was in all the gloom, including the guidance of UPS, they announced a massive share buyback. And to me, and I'm sure our audience, tweet us in, send us in love notes. If Lisa gets the love notes, I get the hate mail. But within that is the idea of they're hiding how well they're doing.
Yeah.
Guidance is tough. We're going to lay off at 3M, et cetera. But use of cash, there's a real oddity going on here.
Well, tech's not hiding it. We'll get Meta a little bit later. Amazon tomorrow, next week, Apple. You got something to say again?
I think it's really important on a Wednesday here. We got things to look forward to. This morning, Lisa did a great job of this. We got Boeing, we got Norfolk Southern, and then we got Arsenal.
Oh, that's the proper one, yeah.
That's the proper one.
That's the big release a little bit later. Looking forward to that. Let me get you up to speed on the price action. Your equity market looks like this on the S&P 500. A lift by a third of 1%. A much bigger lift on the NASDAQ off the back of those big tech results after the close yesterday. In the bond market, 340 on a 10-year, on a 2-year, a break of 4% yesterday. Significant stuff off the back of weaker economic data from the regional Fed indicators. And Lisa, I don't think I've ever seen money supplies discussed so much like it was yesterday. I think that's the first time in a long, long time we've talked so much about M2 back on the agenda.
Well, this is the interesting thing. Amid all of the optimism in tech, you're seeing real pessimism in the underlying economy, whether it's consumer confidence, whether it's the regional Fed surveys, or whether it's this idea that the tightening is taking hold. And that's the reason why I think that today, the sense of business investment that we get from U.S. wholesale inventories and durable goods for the month of March that is due at 8:30 a.m. will be interesting. It could feed into this discussion because here we are talking about American resilience, corporations still making money, doing well, and people are pricing out rate cuts, pricing out rate hikes, and pricing in more rate cuts by the Federal Reserve. So what gives? Is this really an economy where companies can pass along price increases to consumers that are endlessly strong, or is this an economy in decline? Today, we do get Meta reporting after the bell. Those shares up more than 70% year to date. Can they come through with the same kind of optimism that we saw from Microsoft, boosted by OpenAI, and Google? Is ad spending still remaining resilient at a kind of motley time? And today, the other interesting earnings, Tom, as you mentioned, Norfolk Southern to report at 8 a.m. We'll be talking about what happened with the fallout from the derailment in East Palestine in Ohio, as well as Roku and Mattel. Some of the specific stories are really interesting. With Norfolk Southern, regulation is one of the keys here. How much more is there going to be?
It's going to be interesting to see. And of course, the separation of each company with their forward guidance. I'm looking for forward guidance from Arsenal at 3 p.m.
I'm watching the same thing. I can't wait for that game. I can't wait for that game.
Come on, it's the game of the year.
If I'm not good on Meta tomorrow morning, you know why. I was distracted when those earnings came out. Joining us now, Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, you've been bullish. I'm reading through your notes. Not enough right now to turn defensive. In fact, you say the next positive catalyst is about to hit us. Max, what is it?
I think it's partly the earnings season, right? What we've seen yesterday, that sort of confirms that earnings are not as bad as feared. That's good, right? And what I've taken away from you guys now in sort of the introductory remarks is the muddle, right? Muddling through. And quite frankly, I love this muddle right now. It's the best thing that can possibly happen to us right now. Because quite frankly, if we got things too good, then, what Lisa was just saying, well, we're probably going to then price out the rate cuts, and we're actually going to price in more rate hikes again, right? The rates vol is going to pick up again. So we don't want things to be too good. And likewise, we don't want things to be sort of falling off the cliff. So it's actually really good to have a couple of things surprising to the upside, a couple of other indicators surprising to the downside. That's great. That's absolutely great from a risk asset perspective. It means lower vol, it means lower rates vol, and it means that actually we can get going on risk assets a bit higher.
Max, in the equity markets, can you have a bull market or can you have a constructive market if a certain percentage of the stocks don't participate?
Well, I do think so, particularly, when you look at the last couple of years, what that's done to market capitalizations, what's that done to market concentration, and that obviously hasn't changed, right? That's not been sort of put to its head yet. So we do see that some of those names, let's say like yesterday, that have reported have such an outsized weight that perhaps something like First Republic like yesterday, that doesn't carry the weight as much. And I would say also the same applies to Europe, right? We have in Europe a bit of that sort of China reopening trade and the proxy trade with China reopening, better consumer spending, that's coming through. And then we've got on top of that also really the realization that European growth, both in the UK and in the Eurozone, is not as bad as feared. It's not great. It's not rock and roll, but it's absolutely not as horrible as people have feared perhaps 4-6 months ago.
Max, how long can economic muddle be Goldilocks?
Yeah, I think it's probably going to go towards the summer. So our timeline is really towards the summer, beginning of the second half, the next sort of 3-4 months still. Because the problem then will be that we will have much higher earnings expectations, also much higher top-down growth expectations. And bear in mind, right, the narrative for 2023, just a couple of months ago, was the first half is going to be bad, then the Fed's going to pivot, then you get a recovery in the second half. So that means the bar to beat on the earnings side and the top-down side in the second half is going to be much, much higher. On our estimate, our forecasts, headline inflation in the US is also going to re-accelerate towards 4.5% by the end of the year. And we still have a bit more than 2 rate cuts by the Fed being priced in. And that sort of bites each other, right? That cannot happen in combination. One of those will be wrong. So our timeline is really towards sort of the next 3-4 months, towards the summer really becoming a little more defensive and a little less constructive.
Forgive me just for focusing on one thing, but next week, the Fed coming into view. Max, where does that leave the Fed decision next week?
I think it's basically more of the same, right? If I was the Fed, I would be as boring as possible, right? I'd basically say, you know what, 25 bips will not give you as much guidance, right, as you possibly think. So we're not gonna be concrete on this is definitely gonna be the last, or there will definitely be another one. I'd be basically reiterating, okay, you know what, we're still data dependent. there might be better labor market data, or there might not be, opening the door for it to be the last, or opening the door or leaving the door open for another 25 basis point one. I think, as long as they do that, I think it's going to be a pretty non-event.
Max Kettner stays bullish, Chief Multi-Asset Strategist over at HSBC. Max, thank you, sir. Steve Englander over at Standard Chartered put out this note overnight. A dovish hike in May would ease financial conditions. A hawkish hike could destabilize things. He goes on to say, a hawkish pause leaves the most room to follow the data. Sounds like a bedtime story for kids, doesn't it?
Hawkish pause?
A hawkish pause.
I think it's banned.
A dovish hike
They
in
played
May
Neil Young like nobody.
would ease financial conditions.
They really had a tone like Crazy Horse.
Not too hot, not too cold, Tom.
Yeah,
Just right.
Yeah, hawkish pauses,
Yeah, get it
they're,
done.
They're good.
Mm.
They played Talagis in Boulder every Tuesday afternoon.
There was something in that note, though, that was really interesting that he highlighted, which was core CPI ex-shelter has gone back to the range that it was in from 2000 to 2019. Underpinning the divergence in views is where are we in the fight on inflation? And I think in the earnings reports, you also see, really motley picture with some companies able to raise prices more than their fundamental costs and others not so much.
Yeah, but you bring up a really important point. We've sort of lost in all the news flow and narratives that we're talking about the inflation watch. And the answer is, if you throw on a 4% inflation watch and you don't believe in Michael Darda's 2% inflation, but if it's 4% plus whatever GDP is, you get revenues still are pretty good, and maybe you get another good quarter of earnings that nobody's expecting.
Well, just to build on what Lisa talked about, let's sum it all up. Procter & Gamble, Kimberly-Clark, was it Pepsi this week, Coke this week, same thing,
10% increases.
Double-digit increases across the board, and the consumer doesn't seem to be pushing back.
Not at all. In fact, that didn't bother their bottom lines, their revenues. What I love is also Chipotle. They beat earnings in part because avocado prices went down. So you see these sort of
put out an informed tweet on that. Did you write that tweet from Chipotle?
I just think it's just these
She
little
goes for
moments with the volatility and inflation, an opportunity for some of these
She
companies
goes for
to
the
cash
burrito
in.
bowl. She stays for the margaritas.
You don't strike me as a Chipotle guy.
Yeah, they don't sell margaritas.
At all. There's a man who's never been in.
Exactly.
Right? They should sell margaritas.
100%.
There's a man who's never been to Chipotle. Yesterday, First Republic cut in half. This morning, struggling to bounce. Up next, Christopher Marinac of Jenny Montgomery Scott on a beleaguered bank in the United States.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy is moving ahead with the vote this week on his bill, linking a debt ceiling increase to spending cuts. Still, the measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in space. High-frequency indicators in China show that the economy kept expanding this month. Still, the strength of the recovery is under scrutiny because of unemployment and uncertain global environment. Bloomberg's index of 8 early indicators rose in April, and that was largely due to a jump in car and home sales from a year earlier. Shares of Microsoft are higher after the company posted quarterly profit and sales that were better than expected. Corporate cloud computing demand was resilient, plus the company gave an upbeat forecast for its growing artificial intelligence services. Microsoft will step up spending to meet customer demand for new AI tools. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
DOJ or other authorities.
Could face bigger challenges. Was next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The outline speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We need to have clear standards that apply, that are transparent, and I'm really concerned about the fallout. In particular, I'm concerned that we're seeing a flight of capital away from community banks, away from mid-sized banks to the giant banks.
In many ways, that's precisely what we're seeing. Just a fantastic exchange yesterday, a conversation between the Republican Senator Ted Cruz and our colleagues Anne-Marie and Joe Matthew on balance of power yesterday evening. If you want to watch that in full, you can do on Bloomberg.com and on the Bloomberg terminal. If you're just tuning in, welcome to the program. We've got a lot to get up to speed on, including the price action right now with your equity market just about positive on the S&P 500. But that masks some big moves elsewhere in big tech. Microsoft absolutely flying. A beat on the top and bottom line from Microsoft and a strong guide about what's to come around AI, enough to boost this name by almost 8% in the pre-market. Wow. That's the good stuff. Let's get to the bad stuff. This name right here, First Republic, cut in half in yesterday's session. It is now positive by just 3.8% this morning. It's a single dollar stock, Tom, $8, a single digit name now, $8.41. From Jenny Montgomery Scott yesterday. Listen to this for the title of a note. FRC needs to pull off the mother of all pivots to survive.
Yeah, there's no question about that. And what's important here, and really the reporting led yesterday by Gillian Tan and Matthew Monks at Bloomberg here on what needs to be done at FRC. Christopher Marinac has not been a stranger. We really thank him for his participation, seems like day after day. Director of Research, Jenny Montgomery Scott. Christopher, what was out there yesterday, article to article, research note to research note, was a guesstimate of the haircut needed. Let's review. They have garbage loans, jumbo mortgages taken out at 2%, whatever. You can do the math. Is there a way for you to ascertain the required haircut for their management to find stability?
I think there is. I mean, they have a lot of government securities and loans that are simply underwater because of interest rate. It's important that it's not a credit issue. It's more interest rates, and they've got fixed rate mortgages that were done at 3.5%, and the world's easily 2 points higher, if not 3. So that is the reason for the haircut. And of course, it's the uncertainty about the ability to raise capital. That's always where the challenge is for these banks, going back many, many years and cycles. So I think that the lack of knowledge and, of course, the lack of questions Monday night didn't help matters. And so here we are. I think that the company needs a solution. There's 3 ways out of this. They can raise capital, they can sell, or they can fail.
Well, what's interesting here, Christopher, is the optionality this morning for Secretary Yellen and other government institutions. Do you suggest it'll be a clean haircut with or without government intrusion, or will they be able to negotiate some form of more full balance sheet takeout that includes some form of equity option?
So the Treasury has a program in place for community development banks, CDFIs, where the Treasury actually invested preferred last year at a 0% rate for 2 years, and then it was 2% after that. they would have to make a special dispensation to make First Republic a CDFI, but it's not a crazy solution. It would actually give them capital from the government, a la TARP, like we did in 2008, but that would be a one-company solution. I'm not necessarily sure they're going to do that, but it is an option that our secretary has at her disposal if she wishes to.
Chris, you said 3 options: raise capital, sell assets, or fail. Let's assume, for good reason, they don't want option 3. Can you tell me what option 1 actually looks like? What would that look like, raising capital?
Sure. So they would have to do a combination of, I think, equity and preferred. Equity is the best alternative. It would most likely be done, of course, below last night's price, but maybe not necessarily a lot below. It would allow the tangible capital to recover, take losses, move down the road, live to fight another day. I think the question is, will the company dilute their shareholders, existing shareholders, by such a massive amount? I mean, we saw this happen in 2008, 9, and 10, so it's not the first time we've been through this exercise, but I think it's a question of whether the board and the management team are willing to dilute their existing team. I think they're going to have to, unless they can find a bid that's more reasonable.
Christopher, we're talking about this particular company, which we're now debating whether it's idiosyncratic or whether it's representative of perhaps larger ills in the regional banking sector, albeit a more concentrated version of it. How do you look at this in terms of what it exposed about the broader sector?
So overall, credit quality is still really good. Banks give out way better information today than they did 15 years ago. So if we looked at substandard rated credits, special mention rated credits, anything that's not a pass, you typically have 2 to 2.5% today that's problematic at a bank. That's a long way away from where we were at 8, 9, 10% back in the great financial crisis. So we have a long way to go for credit quality to match the last cycle. So I feel like the credit's not the issue. This is an interest rate risk problem, and of course, many banks have held-to-maturity securities, available for sale securities that are below water. And even though rates are down, they're still below water, easily 10 to 12%. So we have to either raise capital to create confidence around those losses, or we simply have to wait. In the case of First Republic, it's impossible to wait. They need a solution, and they need one very quickly.
We also have to think about what the implication is for lending and just loan creation. UBS analysts put this out. They say that bank, commercial, and industrial loan growth looks to drop about 5% in the last 3 months of the year, and then 10% in the first quarter of 2024, which is associated with recession-like conditions. Do you agree? Are you starting to see that type of necessary response to the lack of deposits, to the concern around the balance sheet?
So I would disagree with the percentage change. I think that the tightening is clearly on. Banks are going to be very careful about the standards that they make and the way that they allocate credit. However, the flip side is going to be that they're going to charge a lot more for that. And I think the earning asset repricing in the banks is actually better than folks realize, which could actually be a positive for net interest margins beyond this quarter. This quarter will be a challenge, but I think in third and fourth quarter, we could see not only stabilization, but actually increases in margins.
Chris, I get that this was only really kicked off in the middle of March 8th with SVB, but we've understood the rate story for a long time now. It's a pretty aggressive hiking cycle last year. I'm already getting messages from people saying, what took so long to consider asset sales this large? What have management been doing?
Well, it's a great point. I think that a lot of companies thought that they could simply use their liquidity from the home loan banks and other sources to work through the issue. And I think that was a false narrative for sure. I think the reality is if banks would have been more likely to hold money at the Fed all along instead of buying treasuries, it would have been an easier solution. They wouldn't have had the mark-to-market issue. I think the mark-to-market accounting is what has been harmful here, no different than 2008 and 9. But it is what it is. We have to account for this every quarter. And of course, I think the lack of understanding about when banks would see either sales of their securities or simply just the natural amortization, I think has been one of the challenges. We're getting better transparency, but I still think the issue is to raise incremental capital to create confidence around the issues that we still have these mark-to-market securities.
Hey, Chris, just wonderful to get continued input from you on this story as it evolves. Thanks for being with us. Christopher Marinac of Janney Montgomery Scott on the latest from First Republic with just a stunning note just yesterday, Tom, with the headline of it reading, FRC needs to pull off the mother of all pivots to survive. And Chris basically offering 3 options: raise capital, sell assets, or fail, and they're certainly going to try a combination, Tom, one or the other.
Yeah, I like how you had that one, and you were looking at item number one, and that's maybe a static analysis wrapped up management. I think Lisa absolutely nailed the dynamic nature of what we're seeing with the banks, and I'd go with a lending slowdown. Michael Darda alluding to this in a phenomenal overnight note. But there's another one here, John, nobody's talking about. The revenue producers are walking out the door. And this is, I can't say enough, how 20% of the revenue producers produce 80% of the profit, and that means 80% of the profit margin dynamic is moving out the door right now. I don't want to mention the names because I don't have them in front of me, but to all the other firms we talk to each and every day.
Well, we can talk about a name that's failed. Similar story to Credit Suisse, Lisa, in the last year.
And that's really the key issue that they talk about. With UBS integration, how concerned are they about retaining the talent?
Looking ahead to the Federal Reserve next week and the data we've had so far this week, Francis Donald of Manulife Investment Management coming up. Your equity market just about positive on the S&P, positive 0.26%.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
Equity markets positive this morning. Let's wrap up the price action for you on the S&P 500, positive 1/3 of 1%. But here's the boom. The Nasdaq 100, positive 1.2% this morning. A lift given to it by Microsoft, up by almost 8% in the pre-market. Their stock is flying. A beat on the top and bottom line from Microsoft, some encouraging words about the cloud, and of course the future of artificial intelligence and what it means for search, Tom. A lift for that name and others too this morning. Amazon off the back of that, positive. Looking ahead to earnings from Meta later, Amazon tomorrow.
And the Dow Jones component, First Republic Bank, has a nice lift up to 850-ish, and just moments ago begins to roll over. It'll be very careful here to see with an 832 on First Republic. For those of you bored by this, I'm sorry. It matters to Global Wall Street. We're going to be following near every tick of First Republic this morning.
First Republic still trading with an 8 handle in the pre-market, cut in half in yesterday's session to around about 8 this morning, positive by 2.7%. That's the price action at the single name level. Here's the bond market for you. Last week, Monday through Friday, 2-year north of 4%. Yesterday, a break of that level, 392, down 3 basis points on a session again, dragged lower by these regional Fed indicators suggesting some disappointing economic numbers might be in our future, off the back also of this big talk about money supply contracting at the fastest rate in who knows how long, and we can talk about that in just a moment. I want to finish on this in foreign exchange. Keep an eye out on a certain level. Euro dollar, middle of this month, middle of April, the euro against the dollar, 110.76. We're back to 110.50. We're positive 0.7%. Strong euro story in the mix this morning, TK. That's one to watch.
Yeah, it's one to watch. I'm going to go to euro yen. I thought Jens Nordvig and Steve Englander yesterday were just really outstanding on this. And there's a debate out there. Jordan asked Villa. I mean, he's looking for stronger euro.
You wanted to mention Villa. Villa's doing better than good.
Highlights. It was good.
You know, I got a lot of messages yesterday that still want your review of the Spurs game over the weekend.
My review is, and I don't know if you saw this, John, but, you know, they've come out, they blew up the coaching staff, and then they came out with they're putting up a fan appreciation committee.
They're refunding the fans.
I literally had...
Have you ever seen anything like that? They're refunding the fans.
I almost spit the olive out on that last sip of my martini.
They're giving the money back to the fans because the game was that bad.
No, the players. The players are doing that. I didn't read that, but yeah.
Amazing.
Yeah.
Amazing.
Never seen it, Lisa.
Yep. I don't want to go back to the dollar, but I just wanted to say one thing about that was interesting. Stan Druckenmiller, did you see the comments that he had?
I missed that.
Where basically his one top conviction trade was short the dollar. And it was because of policy missteps. It was because of policy missteps both by the Federal Reserve as well as a potential debt ceiling debate. I mean, it was all around the most bearish thing I've ever read in terms of his view, but really telling at a time where he didn't have much other conviction.
Well, absolute legend of the FX market, going back to the story with Soros, which we've talked about many, many times. Can I discuss the other half of the Druckenmiller view that was in the Financial Times? The trade he missed, maybe the biggest miss of his career, one of, suggested by Druckenmiller, going long the US dollar last year. And the way he explained it, I thought was really interesting, that he didn't have much faith in this administration or this Federal Reserve. And ultimately, that was a reason why he didn't want to get long the US dollar. And that was a trade, obviously, that fell apart at the end of September, where we saw some major, major moves off the back of a much stronger dollar, weaker euro, weaker pound, and that's turned around over the last few months. On the outlook for the US economy, Francis Donald of Manulife has this to say: it's fairly clear to me that we're headed for a material slowdown or recession. And if we are in a normal environment, I'd be preparing our investment teams to consider when it will be a good time to jump back into risk. But this isn't a normal environment. It is still a COVID-distorted economic cycle. Tom, I know you love that line. And thus we have two flies rather, in our model ointment. Thank you, TK. 2 flies in our model ointment.
Francis Donald joins us right now. This is an important brief, really good at the minutia that adds up to our gross domestic product. Francis, if we don't get a recession, but we get sort of kind of like a muddle, 1.5%, 1.1%, 0.7% GDP, not under zero, what does that feel like?
Well, it depends how the central banks respond to it. But, Tom, I'm more concerned about that very slow but persistent weakness than I am about a garden variety recession. We know what to do in garden variety recessions, and we know that central banks historically pivot. But what we're witnessing is, yes, a COVID distorted economy where we're seeing desynchronized elements. We're seeing a consumer that hung on much longer than they would have in other cycles. Housing is already starting to reaccelerate. I'm not sure we're going to get the same sort of response in things like GDP data to the traditional shocks that we've seen. sustain. And therefore, the risk is that we continue to hear, well, there's no recession, and therefore you can go long. But if the Fed says, well, no recession means we hold, that's a very different investment playbook.
Francis, you got a colored dot chart. It looks like the new Louis Vuitton purses that everybody's buying right now. Don't ask me, folks, while I know about that. But the chart you mentioned is one of your great concerns, is what Lisa mentioned earlier, which is M2 growth. I'm surprised that Francis Donald was going monetarist on us. Discuss that.
Well, actually, I'm not just a monetarist. We look at all elements that potentially lead to economies doing poorly. And that's the problem here, Tom, is that no matter what way you assess where growth is going, basically every traditional leading indicator of recessions is flashing red. And some of these are flashing red, not consistent with garden variety or small recessions, but some of the big problems that we had, like in 2008. Now, is that necessarily where you're going? No, but what I say to my team is, even if we cut in half our concern about downsides in growth, we're still looking at a very difficult economic environment. And to ignore the breadth of the challenges that exist and the breadth of the weakness we see in leading indicators, I think is going to be problematic.
And what's interesting here, Lisa, is Liz Ann Saunders really underscoring this out on Twitter yesterday, where you were on M2 growth.
Well, and John was mentioning earlier as well, this idea of what happens when suddenly the restriction by central banks starts to play out in markets. Francis, you say that an economic muddle might not be so great. It's very difficult to read because we don't understand what the different inputs are and where we are in the economic cycle. But if you just take it at face value, why isn't it the Max Kettner view of things, where basically if it's not too hot, not too cold, the Fed's kind of stuck in the middle and things can grind forward at least for a few more months?
Because we're at extremely high levels of interest rates for this level of the economy, and we're heading towards a sizable credit crunch. And this is why data like the senior loan officer survey that we should be getting by May 8th is going to be just so incredibly important. Because even if GDP numbers are not negative, this is still an economy that's going to struggle to produce revenue. It's going to struggle to produce jobs. We're going to have to move away, just like we've moved away from the concept of the unemployment rate, giving us a good sense of the health of the labor market. We're going to have to move away from GDP as giving us a good sense of general economic activity that exists. And if the Federal Reserve is still going to be focused on these traditional indicators like GDP and unemployment and even the PCE inflation rate, then we're not going to get relief from them. And this is a market that has already priced in some relief. So the problem with slow growth that isn't a full-blown recession is that we likely don't get relief on the rate size. And this is going to produce a challenging risk environment.
So, Francis, when you start talking about some of the challenge profits and things at corporations, this has been one of the most surprising aspects of this earnings season. I was looking yesterday at Procter & Gamble, at Kimberly-Clark, and their profit margins expanded. They were able to raise prices on consumers more than their underlying inflationary inputs. What does this say about just how much weakness or not there is, how much tolerance there still is in consumers to absorb all of those price increases?
Well, it speaks to the desynchronized nature of this environment. But as we move forward and we see credit pull back even more sharply, and we see some of the challenges that flow through primarily to small businesses. I mean, let's remember that small businesses are heavily credit dependent, and they've created the majority of jobs since 2020. So as companies start to feel the pinch through the credit channels, they're going to have to be cutting costs in some way. And I think that's going to flow through into the labor market. So again, we have a consumer that held on longer than it would have historically, but all evidence suggests excess savings are coming down. Credit is not going to be available. And as you know, Lisa, there are already some signs that the labor market is going to weaken. So right now, there's some ability to absorb those price increases, but 6 months from now, not so much. And this is when the story is going to change. And it comes back to our job is not to tell us what's happening right now. Right now, we're okay. It's to look forward 6 months. This is why it's so key to disaggregate between coincident indicators, leading indicators, and lagging indicators. And when you do that, sure, coincident data is just fine, but the leading indicators is where the challenge is, and confusing those two, I think, muddles the story.
Francis, the Bank of England has a message for us all. We need to accept that we're poorer, apparently, in one of the most insensitive remarks we've seen from a central banker since Governor Bailey told us all to stop asking for a pay rise. This is what Hugh Bill has got to say. What we're facing now is the reluctance to accept that, yes, we're all worse off, and we all have to take our share to try and pass that cost on to one of our compatriots and say, we'll be all right. but they will have to take our share too. This is bizarre. He's effectively saying, Francis, we need to accept that inflation is high and that wage growth won't be enough, and we shouldn't push for higher wages. Francis, what do you make of those comments from Hugh Pill of the Bank of England?
Well, it's concerning in the sense that we know the bulk of these challenges have hit low-income households across the world who've seen their share of spending on food and energy rise. I do interviews where the person prior to me is talking about, record lines in food banks. So telling somebody that is struggling to put food on the table that they have to accept higher inflation is going to go down a little bit more problematically. However, the bigger investment concern here is that, again, we are used to in an environment where central banks provide relief, a central bank put. And comments like this keep me up at night because they say, some of the difficulty we're seeing in, banks, some of the difficulty we're seeing for households is a feature, not a bug of current central bank policy. And it suggests we have to reassess that decision-making function for all central banks globally. And if we do that, we may not be getting the standard relief rally that comes when you see lower growth. It's effectively a stagflation response function, and it is much more challenging for almost all asset classes than a two-quarter dip, a Fed cut or a Bank of England cut, and a reacceleration. I'm not sure the market has fully grasped on to the risk of a recession with no rate cuts. Comments like this worsen my concern.
Francis, thank you. Francis Donald of Manulife Investment Management. That line from Hugh Pill of the Bank of England, the chief economist. There is a reluctance to accept that, yes, we're all worse off. Bramo, is that something we need to accept?
Let them eat cake. I mean, this is his Marie Antoinette moment. Honestly, this is basically going to be railed against exactly for what Francis Donald just said.
It's another embarrassing moment for the Bank of England. If there was a moment not to talk or do interviews, I think when you've got thoughts like those,
100%,
maybe that's a moment not to talk or do interviews.
He's still declaring victory. Remember that headline? We're declaring victory.
On what?
Okay, exactly.
Oh my goodness.
I'm not making jokes about it. England to me is way worse than what's going on in the United States right now. It's scary.
Well, we can have a conversation about
Scary
that, Tom.
stuff.
In your equity market, positive 0.2%. The euro stronger this morning for sure. The euro against the dollar, 110.53.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is confident his bill linking a debt ceiling increase to spending cuts will pass on the House floor this week. This despite divisions within his own Republican Party that threatened to vote against his proposal. Some don't agree with the measure's ethanol tax breaks and work requirements for Medicaid recipients. The U.S. will gradually lift sanctions on Venezuela if the country moves toward restoring fair elections. That's according to the Deputy National Security Advisor, John Feiner. He spoke in Colombia, where there's a summit aimed at restarting negotiations between the Venezuelan government of Nicolas Maduro and the opposition. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. U.S. companies in China are growing more pessimistic about the relationship between the two countries. According to a survey from the American Chamber of Commerce in China, 87% of those responding are negative about U.S.-China ties. That's 14 percentage points higher than the previous survey. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Microsoft magnificently positioned. So is Google. So is Amazon. So is Meta. These folks own the largest computers in the world, and they're going to rent them out to everyone else, and everyone else is going to enjoy a 500 basis point margin improvement over time. And that's going to be very good for the economy.
Charles Cantor was just absolutely brilliant in yesterday's conversation. Charles Cantor of Neuberger Berman and some of the big tech names. The enthusiasm for the likes of Microsoft reflected in the moves we're seeing this morning on Microsoft, positive by close to 8%. Equity futures get a lift as well on the S&P, on the NASDAQ. The NASDAQ absolutely flying this morning off the back of these numbers from Microsoft. The NASDAQ up by more than 1%. The S&P 500 futures positive about 0.25%. The name I want to sit on just for a moment, though, before we go forward and talk about tech. We've just rolled over on First Republic in the pre-market, so we're negative on the session.
Rollover.
It's a break of 8. So it's a break of 8. We're now trading in the 7s on First Republic after this stock, Tom, got chopped in half yesterday, and all the talk this morning, the follow-through from yesterday, really, asset sales up to maybe $100 billion worth. We spoke to Jenny Montgomery Scott moments ago, who have got basically summed it up as follows in their research. They need to pull off the mother of all pivots to survive. That pivot is either going to be a combination of asset sales, Tom, and a capital raise somehow.
They're going to have to see. Our Shonali Basak here with our team. Our team is up in San Francisco working on this, and of course over to Washington as well. John, do you think Washington gets involved in this discussion today? I would guess they do. Right now, a new low, John, 7.75.
Well, things moved pretty quickly with SVB, didn't they?
Yeah.
It moved pretty fast. This has moved really, really quickly. It's only still, still April, and this already got going.
It's a British phrase, OBE, overcome by events.
Big time, big time.
There it is as well. Let's move on here right now. And what we're going to do here is, off of Charles Cantor's wonderful comments, talk about your reassessment on big tech. Timothy Horn is senior analyst at Oppenheimer and joins us this morning with a real gift here on Microsoft as well. Tim, let's go back to the time of Rick Sherland and an old Microsoft of old. Let's begin with the new Microsoft. How is this Microsoft different than the Microsoft Rick Sherland covered years ago at Goldman Sachs? How's a new Microsoft different than our stereotype?
Well, for one, it's not a monopoly anymore, so they've learned how to compete and create new products, and they've totally positioned to the cloud, where they were really far behind Amazon, and as a result, they've had to be, I think, a lot more innovative. So you've seen them take the lead on AI, and they kind of optimize their infrastructure, their whole business model right now around AI, which is very different.
What is their use of cash picture? We saw a share buyback from Google that was stunning. We see it, frankly, from others outside the sector. But do you look in the forward here with this good news, with margin resiliency, with the defensiveness, a constructive tone? Do you look for a new use of cash in share buyback and dividend?
They're going to be pretty steady. They have a steady dividend, that's going to grow in line with earnings. Steady buybacks going to grow in line with earnings. They did say they're going to spend a lot more money on CapEx, for AI. These new NVIDIA chips are very expensive, and they're buying an awful lot of them.
Do you buy the promise of OpenAI, Tim?
Totally, completely and totally, I buy into it. I think it's going to be the most profound thing we've seen in 10, maybe 20 years or longer. I kind of think back when I first got on the internet 30 years ago, how much of a revelation that was and how much it changed my life. And I think we're going to look at the same thing.
So then, if that's the case, is it a real liability for Alphabet that they kind of downplayed it, perhaps to get a competitive edge with respect to Microsoft, perhaps to downplay fears that they're going to lose some sort of preeminence with their Google search engine to Microsoft? But do you think that they're going to be left behind because they're not emphasizing it to the same degree?
It's going to be the critical 6-9 months ahead of us because OpenAI gets better and better the more people they have using it. But we know that Google and Amazon are throwing billions of dollars at AI. We know they have very, very good large language models. The key is they got to get them rolled out and get people using them, or else Microsoft will once again become the operating system like they did with the PC for one of the most important technologies for the next 20 years.
I understand the promise of this purely from a technological point of view and the promise in terms of efficiency as well as productivity, Tim. But what is the time frame for this being actually profitable for the likes of Microsoft?
For OpenAI, for them, they have a product called GitHub Copilot, which is helping people write software, and it's improved the amount of software any programmer can write by 50%. They charge $10 a month for that, and they have 10,000 companies using that product. They're going to charge similar kind of add-on for Office 365, and that will probably be in the next 6 to 12 months. They'll start really adding on prices on these different applications. But importantly, they're just bundling together a whole set of new products. They're getting a whole set of new customers they never would have gotten before. New startups would have gone to Amazon. Now they're going to Microsoft.
And Tim, you've been doing this for ages. Can you extrapolate what you witnessed yesterday with Microsoft up pre-market 7, maybe even 8%? Can you extrapolate that over to all the other techs, over to Apple, over to NVIDIA, over to Broadcom, et cetera?
That's a great question. I think Microsoft's gaining share. So it's going to be a little difficult. I mean, Amazon's quarter is going to be very important, but I think this is company by company. Talking to them after the call, they're not trying to say they're a leading indicator on macro. They don't really know where macro's going. It probably is slowing down. If you listen to Mr. Druckenmiller, he's calling, as you were referencing before, for a hard landing. But they think they're gaining share on like 6 or 7 different products, and they're probably right. So I'm not entirely, sure what it means for the whole tech sector at this point.
Tim, as you talk about this arms race in artificial intelligence, where are the ethical concerns, especially as a lot of tech giants have been talking about perhaps pumping the brakes a little bit and understanding it a little bit better before it gets rolled out in some sort of mass?
It's a great question. I'm no expert on it, but, automobiles kill a lot of people, firearms kill a lot of people, go on and on. A lot of medicine kills a lot of people. It doesn't mean that we've kind of stopped developing medicines. And I think the genie's out of the box here in AI. We're moving forward. Whatever happens, we're just going to need some regulatory, I think, guardrails around it.
Hey, Tim, thanks for the latest on Microsoft. That stock is up by close to 8%. That's the name we'll be focused on going into the opening bell. Here's another one. Breaking down still on First Republic in the pre-market. FRC down to about 750-ish. We're down about 6%, Tom, on the session.
We try to avoid here. It's the heritage of Bloomberg surveillance, inflammatory words. John, this is a plunge. Now a new low. There is no bid.
Well, just to be clear, yesterday was a plunge. I think we've had to redefine what a plunge is for this name. Got cut in half. Down at the close, Lisa, by close to 50%.
And now people are parsing through whether this is very specific or whether this is something broader for the regionals. Tony Dwyer and Tom, just give me 1 second. Tony Dwyer coming out and saying that his view remains the same, that this highlights some of the concerns, the broader concerns in the bank industry that does affect their belief in recession. And we saw that yesterday. First Republic, the small bank, dragged the entire market down.
May I suggest, without any news knowledge, that just perhaps we see government announcements before the market open on this?
No idea. No idea.
Why?
You can speculate.
Well,
you can speculate.
Are we going to enjoy this at $6?
I don't think anyone's enjoying it, that's for sure. So I'll give you some good news. If you look at KRE, the regional banking ETF, which is followed by
Yes.
a lot of people, you can get a pre-market view of KRE, and it's still positive by 0.5%. So the more this is isolated, the more confidence, more comfort that I think we can take away from this situation. And that's the thing that a lot of people are going to be focused on. Does it lead to difficulties elsewhere? Will it be isolated to this name? Certainly this name, Tom, still falling, down a little more than 8%. Meanwhile, elsewhere, Lisa, you are still seeing things just about hold up.
And that's because of this sort of muddle through that you're seeing with some beats and some misses, and how much is tech really supporting that, as we were just talking about?
Oh, tech in a major way. So Meta later, onto Amazon tomorrow. Amazon with a stealth rally year to date of something like 20% higher, and hardly been talked about. We talked about Meta.
I agree.
Because
Off
it's
the
up by
radar.
more than 70%. Been talking about Microsoft, Google because of AI and this battle, this tug of war between the two names. Amazon just quietly under the radar, putting in a gain of 20% year to date.
In the zeitgeist, I'm sorry, I can't cite the source. Thoughts of Amazon having announcements this Wednesday on expense control, job reductions, moving further away from that COVID overhire.
Looking forward to catching up with Brent Thill a little bit later on some of these themes. Laurie Heinel's going to join us shortly of State Street Global Advisors. We'll talk about the banking situation, what it means for credit creation. Do we get a credit crunch later this year, and ultimately where it leaves the Federal Reserve? The Federal Reserve facing some weaker data through the week so far, which has really started to drag down yields in a material way. We've gone from north of 4% on a 2-year back to south of 4% on a 2-year. Later on Bloomberg TV, Rick Reeder of BlackRock in the 9 o'clock hour, Bob Michael of JP Morgan Asset Management. Bob Michael looking for 3% right the way through the curve, from the 2-year all the way out to the 30-year maturity.
3.00?
3.00,
wow.
right the way through the curve.
That's
We'll have that conversation a little bit later. Your equity market just about holding up but fading on the S&P 500 as First Republic struggles to bounce. That stock is down 8%.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question its industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that, as we've had to, and I think that's the right thing, so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
We're still in a slower growth environment.
I just think that earnings estimates are not really reflecting the fact that we're slowing down as much as we are.
I think tech outperforming, that could be, forward expectations.
Microsoft's magnificently positioned. So is Google. So is Amazon. So is Meta.
Apple, Google, Amazon. I think these are stocks that could be up 15, 20% for the rest of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Two stories this morning, one good, one better than good, the other ugly. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about holding up on the S&P 500. First Republic, anything but holding up. That stock is down by more than 10% in the pre-market, just about holding on to a 7 handle on First Republic. That's the ugly news. Here's the better than good. Microsoft in the pre-market higher by close to 8%. Earnings from that name, tremendous. The guidance around AI, encouraging for the equity market bulls, for this single name at least. That's what they wanted to hear. But Tom, we've got to kick it off with FRC. FRC facing a pretty important moment this morning.
I agree. It's more important than big tech, and big tech, of course, rolls through to May 4th. And then Apple, is this a discrete entity? I'm in the camp, John, where it's really not a contagion like S&L crisis in the early 1980s. There's a lot of people that agree with me on that, and we could be wrong. Is there another FRC out there? That's got to be the massive focus of the Federal Reserve System this morning.
This speaks to the conversation we've had over the last few weeks, that the events around SVB wasn't just an event, Lisa, it was a process. And it's a process we've still got to work through.
And that's why Tony Dwyer came out and said his view remains the same, that you don't see these kinds of plunges in regional bank indexes of stocks without some sort of downturn, that it is notable. You might get a near-term pop, but longer term, they're staying defensive. Good news and bad news. It's the muddle. Do you treat it as just risk off, or do you treat it as a muddle that you can buy?
You nailed it in the last hour with the idea of what does the loan dynamic do. Michael Darda of Roth MKM yesterday said this beautifully, John. The media particularly likes to do interest rate and financial market analysis. There's a point where it rolls over to a real economy balance sheet analysis. Are we there now where asset and liability dynamics maybe matter more than the parlor game of rates?
If you are just tuning in, Chris Marinak was on the program in the last hour from Jenny Montgomery Scott. This line from Chris: FRC needs to pull off the mother of all pivots to survive. He said 3 options: 1, raise capital; 2, sell assets. We think that's the direction of travel; or 3, fail. They're the decisions right now, and I'm not sure anyone at FRC obviously wants option 3. We're going to pick up on this story throughout the hour right here on Bloomberg TV and radio, just to get you up to speed on the price action more broadly on the S&P 500. We are positive, but only just by 0.1% on the S&P. The dollar's weaker, the euro stronger. Tom, 10.76, 110.76 on that currency pair is the line of the cent to watch. That's the high of the year, 110.50 right now.
Some of the dollar dynamics there as well. John, one note as we go to Lisa, and that is the widespread of the 3-month T-bill as compared to the 10-year T-note. As of today, hit 3 standard deviations when you look back 30 years. All you got to know, and it's a cliche, we're in uncharted territory of that high 3-month yield and that low 10-year yield.
And then the other spread we need to talk about, Bramo, right at the very front end of the T-bill curve, with the debt ceiling debate ongoing.
And I wonder how much that really factors into the longer end, this idea that you're seeing 3-month yields, the highest relative to 1-month yields, going back to the early 2000s as a result of that being the sort of D-Day for some of these debt ceiling debates and when the money really gets cut off. Today we're focusing very much on the economic data. U.S. wholesale inventories and durable goods orders for March. This comes out at 8:30 a.m. John was mentioning the regional Fed reports that have come out, soft softer than expected. How much do we get that confirmed in terms of business orders and how much they may be going down? Today, after the bell, Meta is the latest tech behemoth to report. Will it be the same story as Microsoft and Google? Are we going to get the same kind of strength and resilience for a completely ad-driven model, given the fact that Google showed resilience with respect to that business? Those shares are up more than 70%. How much more can the year of efficiency deliver? We will find out. Other interesting earnings to note today. Norfolk Southern coming out in about an hour time with the overhang of what happened in East Palestine, Ohio earlier this morning. How much does this really lead to more regulation, higher expenses, harder clampdown by the U.S. government to try to make sure this never happens again? We also get Roku and Mattel. John, a motley picture of stories that really is not giving clarity in terms of where we are in the economic cycle.
Lisa, thank you. Here's another one. This takes some of the shine off those Microsoft earnings from yesterday. This just in from the UK, this written up here at Bloomberg by Catherine Gemmell. Microsoft's $69 billion takeover of Activision Blizzard has suffered a hammer blow after Britain's antitrust watchdog vetoed the gaming industry's biggest ever deal, saying this, it would harm competition on the cloud. The Competition and Markets Authority said its concerns could not be solved by remedies such as the sale of blockbuster title Call of Duty or so-called behavioral remedies involving promises to permit rivals to offer the game on their platforms. This according to a statement that's come out just moments ago. So here's the state of play. Activision Blizzard, as you might expect, is down hard by 12%. And just taking some of the gloss, the shine, the polish of the earnings story of yesterday with Microsoft, that stock was positive, Lisa, by close to 8%. It's now positive by about 7%.
So this is where regulation and the potential of policy really becomes a really major risk. And it's not just with respect to antitrust. It's also with respect to some of these tech giants and their businesses overseas, in China, elsewhere. So to this point, it's sort of how much can this drive everything if you have that overhang and that potential risk?
I'm looking at John and Microsoft here bringing it off $2. What, John, from up 8% to up 7%. Now we'll have to watch that carefully. But, I'm still back on Call of Duty Ghosts. I mean, it was so good. I just didn't want to go forward here, and I didn't.
You don't strike me as a gamer.
Infinite Warfare.
I don't think
Vettel and I sit there. We're doing Call of Duty Ghosts. We're loving it. It's from like 10 years ago.
Seriously,
really,
have you ever
it really
played
still
it?
Works. Call of Duty.
Yeah.
Yeah, well, the dogs like to watch it. They're like doing this thing. On radio, it's an ugly sight. Wait, on TV, it's an ugly sight.
Value add, TK, value add. Let me bring you some real value add if I can from Microsoft. The latest from Microsoft right now, they plan to appeal to the UK the decision to block the Activision deal. So Activision Blizzard down hard. We just move away from session highs on Microsoft in the pre-market. We'll stay on top of that for you. On the S&P 500, futures fading and fading fast. We are just about unchanged on the S&P now, Tom, with First Republic very much in focus, down almost 15, 16%.
2 seconds from Lori.
Negative.
First Republic, under $7.
Not pretty. Now trading in the 6s.
Yeah.
Laurie Heidel joins us now, Global Chief Investment Officer at State Street Global Advisors. Laurie, once again, we're focused on a single banking name and trying to work out what it means to the broader market story, the economy, and ultimately for the Federal Reserve as well next week. How do you wake up this morning and view those things?
Well, you have to put it into perspective. I mean, clearly we're all focused on the singular name, but the bigger question is, what does this do in terms of financial conditions more broadly? As we know, regional banks are important grease in the global economy and in the U.S. economy in particular, because they originate a lot of commercial loans, they provide mortgages, they do a lot of things that actually help to propel the economy forward. So this is disturbing just through the lens of it's just tightening credit conditions, yet through another lens, even while the Fed continues to tighten.
So at this point, given the fact that we have seen some resilience from earnings of other companies, of other small regional banks, how much can we really understand the systemic restriction in lending that this is going to imply on markets in the broader economy?
Well, we think ultimately it's not systemic in terms of a major run on the banks, so to speak. I mean, you referenced earlier the S&L crisis from the 80s. We don't think it's that kind of environment, but it definitely does tighten credit conditions. And again, at a time when we're already having a variety of other things that are tightening credit conditions, including the Fed potentially raising rates again. So the real question is this an episode that passes over the next couple of months, or is it something that becomes more insidious? And part of that is going to be, what does the Fed do in May? And then more importantly, what do they signal that they're going to continue to do? Because we still have this view that the Fed has gone too far already And if they continue to press on the brake pedal, that could create quite a stress over the summer and into the fall.
So we started the show with Max Kettner, who came on and said, everybody doesn't know what to do. It's this complete muddle. You get some positive, you get some negative, and it's actually Goldilocks. Let's go and go into risk. Why not go that route for the next couple of months at least? If we're waiting to see this, we're waiting to see that, and meanwhile, you've got companies, the bread and butter of America, delivering better than expected earnings.
Well, look, I think this is very much a trading market. And in fact, to that point, we actually went overweight U.S. equities in our most recent tactical allocation call, in part because we do see relatively resilient earnings coming through, and corporate balance sheets are in pretty good shape. So this is not a story that necessarily impacts their ability to finance in the short term. But here again, the question is, how long do you ride that train? It's a momentum play right now for sure, but things that happen over the next couple of months are going to be really critical, because we'll start to get indicators of whether employment is actually starting to crack in a bigger way, if we're actually starting to see credit conditions tighten to a degree which actually might derail the U.S. economy even further than we already expected to derail.
Are we getting indications of any of that right now, Laurie?
Well, we certainly are. I mean, we're seeing every day labor markets become a little bit more vulnerable. Consumer health is a little bit less than it was. We're back to pre-COVID levels in terms of savings rates and earnings power and things of that nature. Again, corporations have been quite resilient, but it's a pivot trade. It's not about just the growth in the global economy and buy commodities, buy things that are geared to growth. You have to be a lot more selective and look where there's quality, where there's relative valuation, and where there's strong cash flow.
Laurie, appreciate your insight. As always, what a busy morning again. Laurie Heinel there of State Street Global Advisors. This from Steve Englander of Standard Chartered, who sees reasons for a hawkish pause in May. Not in June, in May. Next week at the Federal Reserve, followed potentially by a hike in June, unless upcoming data confirm that a slowdown is already in place. Relative to market pricing, we see the risk return as heavily favoring an on-hold position. That's the view from Englander this morning. Here's the view right now in the market. Equity futures on the S&P totally unchanged on the S&P, with First Republic down 20% again in the pre-market. This is a session low.
That's on top of yesterday's.
It's a session low, and it follows on from that close to 50% move lower in yesterday's session. Tom, we trade right now at 640. On First Republic.
Front center for the Bloomberg finance team, and they are looking at all the different nodes. We don't see the speculation yet of what the events this morning will be.
This started the week at the close on Monday as a $16 stock. It has been cut in half and then some, down to $6 in the pre-market. More on that with Peter Shear of Academy Securities in the next hour on Bloomberg TV, on Bloomberg Radio. Your equity market unchanged.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After months of North Korean missile tests, the U.S. will beef up the deterrence it provides South Korea against nuclear threats. In return, Seoul will pledge honor to its commitments not to build its own atomic arsenal. President Biden and South Korea's President Yoon Suk-yeol will announce the agreement today at the White House. House Speaker Kevin McCarthy is moving ahead with a vote this week on his bill linking a debt ceiling increase to spending cuts. Still, a measure is in danger of being sunk by McCarthy's fellow Republicans. GOP lawmakers from Midwestern states have raised concerns about provisions that roll back biofuel-related tax credits and subsidies. The Pentagon is learning some valuable lessons from Russia's invasion of Ukraine. According to Deputy Defense Secretary Kathleen Hicks, those lessons could come in handy in case of a conflict with China. Hicks says the U.S. needs to build a steady ammunition pipeline and continue to innovate in space. Shares of Microsoft are higher after the company posted quarterly profit and sales that were better than expected. Corporate cloud computing demand was resilient. Plus, the company gave an upbeat forecast for its growing artificial intelligence services. Microsoft will step up spending to meet customer demand for new AI tools. And the Bahamas plans to tighten crypto regulations that were tarnished by the collapse of the FTX exchange. The company was based on the island along with its fallen founder, Sam Bankman-Fried. He moved to the Bahamas as the nation sought to become a crypto hub. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Next week, Bloomberg is live from the Milken Conference in Los Angeles. Bloomberg's all-star team will bring you the latest news and speak to the biggest names with the capital, power, and influence to change the world.
Globalization, certainly there's areas it's retreating. It isn't dead, it's just changing.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter.
Live coverage begins Monday at 10 a.m. Eastern Time on Bloomberg Television and Radio.
What we're doing is irresponsible, and I think it is critically important for leaders in the House and leaders in the Senate to force real spending reforms. Now, let me be clear. Under no circumstances should the United States default on our debt.
Senator Ted Cruz in conversation with the brilliant Anne-Marie Hordern and Joe Matthew yesterday on Balance of Power on Bloomberg TV. Fantastic conversation you can find on Bloomberg.com. and on the Bloomberg terminal. Looking at the market right now, the equity market on the S&P 500 totally unchanged on the S&P.
Up earlier.
Was up nicely off the back of better than good numbers from Microsoft. The Nasdaq still positive for what it's worth. Microsoft still higher as well in the pre-market by 7 to 8%, even after the UK comes out to block their deal with Activision Blizzard. The name we need to watch, though, and I'll keep quoting a move for you if you're away from the screens right now. We're in the 6s. We were in the 5s on First Republic very briefly. The stock is down by more than 20%. And I'll share with you the news we've got at the moment. And it's from our team here at Bloomberg, Gillian Tan, Matthew Monks, in the last 24 hours or so, putting this one together. First Republic is exploring divesting $50 billion to $100 billion of assets in attempts, Tom, obviously, to rescue itself from the turmoil that's engulfed not just this name, but the whole of the industry over the last month or so. This according to people familiar with the matter.
In what way? We discussed this in the last hour. In the phrase, folks, the jargon is haircut. So a bond is 100. Maybe it's trading moldy at 72. And to get somebody to be motivated to buy that, where do you price the bond? And that's the discussion that's not happening.
Well, let's make it really, really simple. Let's say I give you a mortgage and rates are at record lows, and that mortgage, you're paying me back something like 3%. Struck a deal, give you lots of money, except
I'm paying out 4% right now.
Rates reset, and all of a sudden that doesn't look as attractive, TK.
Yeah.
What's interesting off the back of that story, though, when you explain it like that, it's interesting that the financial institution is facing some trouble around that, yet we haven't seen much pain in the housing market off the back of it. I think that's actually quite interesting. You look at the most recent housing data, and it looks like I saw piece after piece yesterday, economist after economist, Lisa, suggesting that maybe the housing story in this country has already bottomed out.
So there are a number of different aspects here, including cash, right? That wealthier individuals are just posting cash, so it's not about a credit story anymore on that front. But on the margins, if mortgage rates go down, and that is more closely tied to the benchmark rates of the Treasury, of the Federal Reserve, if they go down, people still need to buy homes, and that deficit of housing is sort of offsetting the tightening in credit conditions. But you raise a good point. Throw in a regional banking kerfunkel, and I almost
nice
used...
word. Whose word was that?
I'm forgetting whose word it was.
I think it was Bank of America, something like that. This is why some people are saying that this crisis is somewhat self-limiting, because ultimately rates will have to reset lower, and it will help some of the assets that are underwater. And I think this is the piece that you were talking about from Mike Dada of MKM, who TK to some extent pushes back against that idea.
Well, this is dynamics, folks. It's really important to understand that this is a multi-dimensional space. We're not going to go in it now. Anne-Marie Hordern's going to stand up and walk off the Washington set. But the answer is, John, yeah, you get a bond benefit, price up, yield down, bond recovery. But with that, you get a presumed slowing economy. And I mentioned earlier, if the revenue-producing talent walks out the door to competitors in, where Boston, Silicon Valley, wherever, again, it's very dynamic here, and that's what we're going to try to capture with all our guests. With FRC, a bounce off 550 up to 668 at this moment. Amory Horton is the only one in Washington at FRC, and she joins us right now.
Well, really, this was already known, right? We knew that President Biden was going to be seeking re-election to 2024. I think what everyone really is starting to talk about is a lot of the focus will be on Kamala Harris. That's really where Greg Valliere took his note this morning, and that's because she, of course, is the vice president. She is going to maintain on his ticket for 2024, but also Biden's biggest vulnerability going into re-election is obviously these questions around his age. He is the oldest serving U.S. president at the moment, and if he was to win re-election, that would bring him to 86 years old. Jonathan and I, though, had this conversation yesterday. This is a president who takes all these trips, has a very robust schedule, and his physician says he's fit right now. Whether or not you look at it, if the election were to be today, whether it was Joe Biden versus former President Trump, the next term, both of these men will be ending it in their 80s.
Forget next year. Let's get into the meat of this morning. Here's a headline for you. AMH, I don't know if you've seen this cross just yet, so I'll share it with you.
I've seen it.
The Chinese President Xi Jinping and Ukrainian President Volodymyr Zelensky holding a phone call. Anne-Marie, frame that one for us.
Well, it's been puzzling that Xi Jinping has yet to call Zelensky since the start of the war, especially after there was this real momentum that the global community thought Xi was going to make this outreach after he went and visited Putin recently in Moscow. He has put out this fuzzy blueprint, if you will, about a peace plan that he would like to see, and yet the United States said that even if this peace plan were real, because most of it really looks like it was to the help of President Putin, he would have to be able to engage the Ukrainians, which until right now, in this moment, knowing that we know that he had the first time this call since the war began with Zelensky, he had not had this outreach to the Ukrainians. So how can you say you want to be a broker of a peace deal when you're only speaking to one side? Obviously, I would cage this with some skepticism, with the fact that obviously Xi Jinping has this, quote, no limits friendship with President Putin. And so recently we saw Chinese defense minister going to Moscow and going as far as to say Putin is a defender of world peace. But this is something that is going to draw applause from the global South, which has really been pushing for an end to this war because they are dealing with very high inflation, high food prices, high energy costs, and they want to see an end to this.
I don't have a readout of this just yet. And just to recap the news again, President Xi and the Ukrainian leader holding a phone call, this according to China State TV. AMH, I'd love to know whether this is a challenge right now to the efficacy of U.S. diplomacy under President Biden and this White House, because it's not just around Ukraine, it's also in the Middle East, where we saw China broker some kind of conversation agreement between Saudi Arabia and Iran. How much of a challenge is this becoming?
Well, Xi Jinping is trying, and you mentioned what's going on in the Middle East, what he's trying to do at this moment. Another headline says that Xi tells President Zelensky negotiations are the only solution for war. But remember what the United States has said, that nothing about Ukraine without Ukraine. Ukraine would be the one to decide how this war ends, because for President Volodymyr Zelensky, going to the negotiating table, he does not want to give up land. And of course, there is still that question of what happens with Crimea. So all of this creates it harder for the United States, because Xi Jinping is giving some countries potentially another plan or outlet that they can sign up for. We saw that most recently with Brazil's Lula going to Beijing, criticizing the United States. And then, of course, closer to home, Emmanuel Macron going to Beijing and saying that they want strategic autonomy when it comes to how Europe views the relationship between Washington and Beijing. So I think this does make it harder for the United States, but also at the end of the day, it was China that was only able to broker the deal between Riyadh and Tehran because obviously the United States was unable to do that. There's no communication between Iran and the United States. Xi Jinping would also be a player that could broker or help broker a deal between Russia and Ukraine because he does have Putin's ear.
AMH, thank you. Anne-Marie, looking forward to the conversation a little bit later on Balance of Power with Joe Matthew, 5 p.m. Eastern Time. They'll be catching up with this man. This is an important one after these headlines. Richard Haas of the Council on Foreign Relations. Just a little bit more detail on this call. Xi telling Zelensky that negotiations are the only solution for war. Again, according to state TV out of China. Xi telling Zelensky that China will send a representative to Ukraine. Zelensky saying his call time with Xi was long and meaningful.
The symbolism here is extraordinary, and particularly after the Soviet Union headlines that Anne-Marie Horton mentioned of earlier this week.
The comments from the ambassador to France, the Chinese ambassador, a little bit earlier on. If you want to get up to speed with the price action, equities on the S&P 500 just about unchanged. Two names to watch. Microsoft up by more than 7%. First Republic down a little more than 20% in the pre-market.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens April 28th on Bloomberg.
Equities on the S&P 500, just about holding on, unchanged on the S&P. After a decent gain a little bit earlier this morning, the Nasdaq's faded too, up by 0.8% after gains of more than 1% a little bit earlier. One name responsible for a big chunk of that move is Microsoft, and Bramo will run you through that name in just a moment. Outside of that, just to focus on the bond market, the two-year yield north of 4% through the whole of last week, a break at that level yesterday and down again this morning by 7 basis points to 388 on both a 2-year. On a 10-year, 338. We're negative there by a single basis point. We are on year-to-date highs, intraday highs of the year. On watch for that on the euro against the US dollar. That currency pair at the moment, 110.47, 110.76 a few Fridays ago. That's your intraday high of the year on the euro. Getting close to it. Weaker dollar story right now. Stronger euro in the mix off the back of some weaker than expected data, Lisa, through the week so far.
Yeah, and honestly, this has been really interesting to parse through the banking sector on one hand and the strength on the other. Before we get to some of the single names, Andrew Hollenhorst came out and said, yesterday we discussed why we saw little new information for the macro economy in the bank results. And he said sales of bank assets is not necessarily a macro concern. Meanwhile, fundamental economic activity data remains mixed, but markets are choosing to focus on those readings that confirm the slowdown narrative. How much is that really what we continue to see in the market?
Just getting some numbers from Boeing, reaffirming guidance. Revenue coming in at $17.92 billion. The estimate, $17.43 billion. Those numbers dropping just moments ago, Bramo. They're reporting. Meta a little bit later, onto Amazon tomorrow.
So let's take a look at what's been going on, what's been moving under the hood. We got to start with First Republic because those shares have been pummeled, cut in half, as you pointed out yesterday, down another 15%. We're really at almost a penny stock, $6.89. We can stop quoting perhaps the percentage changes. And this goes to this question, the existential angst of, does this bank survive? Do they sell $100 billion of assets? Will that be enough? PacWest showed much stronger results yesterday after the bell, reporting sort of stabilization in their deposits and then growth in April. Those shares still up more than 14%, but other regional banks suffering. And you can kind of see this on the edges, down in sympathy with First Republic America, among those down about 1.4%. You mentioned, John, Microsoft, so let's talk about it. It had been up more than 9%. Now it's up just 7.5% after Britain's regulators came out and said they were going to block the $69 billion Activision deal for Call of Duty, which I've never played, full disclosure. And you can see Activision shares down more than 10% in response. Interesting to me that Google, Alphabet, the parent company, those shares are down 1.2% after also beating earnings and giving projections that were really positive. But they didn't mention artificial AI enough, or artificial intelligence, OpenAI and ChatGPT enough. And so people are a bit concerned.
You've got to play the game, haven't you?
Yes.
They're not really playing the game.
Exactly.
Right now. They're basically defending their position, Tom, saying AI right now is something that continue to work on, whereas Microsoft is going through this full-scale embrace, a love affair, if you will, with artificial intelligence, with language like this. We look forward to continuing this journey on what is a generational shift in the largest software category, search. Satya Nadella saying the right things on the call.
They're all the right touchy-feely words, but I'm sorry, it gives pause when someone with the experience of Charles Cantor of Neuberger Berman quantifies it on the income statement and says this will adjust margins. To translate that, John, and I paused yesterday when he mentioned 500 basis points, move the decimal point over 2. He's saying if somebody makes 17, they make $1, they come down, they make 32 cents, say, net margin, EBITDA, okay, we'll go there. EBITDA, they're going to add 4 or 5 percentage points because of AI. That gave me pause.
It's the journey of the week so far.
The journey.
The journey, the first step, numbers from Microsoft and Google after the close yesterday. After the close today, on to Meta. Tomorrow, Amazon. Next week, Apple. A week from today, the Fed decision. Padraig Harvey of ING, of financial markets, weighing in on the impact of potential rate cuts. Padraig saying this: while 10-year yields have seen their peak already, it will need the imminent prospect of rate cuts to re-steepen the curves. We think cuts will come before the year ends, but the Fed is still pushing a higher for longer narrative, keeping re-steepening reflexes, Tom, at bay.
Very nicely done, John. Nice paragraph to pick there. He has really moved the show. It's been wonderful to have Padraig Harvey with us, head of global debt and rates at ING, with us. We've had a huge feedback, Padraig, when you're on with us. Thank you again so much for joining us. today. It's moving in real time. The Federal Reserve is completely fixated on a bank out on the West Coast, First Republic, but they do have a distraction of there's a point where they shift. What's a decision tree you see that will force them to shift to rate cuts?
A recession, Tom, to be honest.
They need an NBER recession out front to move rate policy?
We're going to see a recession out front pretty soon. The labor market is beginning to move. We're seeing claims beginning to rise. We've got to remember that the unemployment rate is a lagging indicator. The odds firmly favor the U.S. economy being in recession in the third quarter of this year. And one of the things that we're looking at here very carefully are lending standards. I mean, it's gone under the radar screen that before Silicon Valley Bank went down, lending standards were already quite tight. Lending standards have only gotten tighter. There's a very strong correlation between the tightening of lending standards relative to the performance of the economy.
So we have a two-part analysis here of are we restrictive, and then you've got other features that many others mentioned making us ever more restrictive. Can you state here, given the cards Jerome Powell's been dealt, he's super restrictive?
He is as restrictive as he needs to be here, but he needs to be restrictive, Tom. I mean, we have faced an incredible inflation challenge. And by the way, this is not a U.S. thing alone. It's a global thing. The Federal Reserve is the global central bank, and they've got to deal with this. So they're going to pitch that funds rate up at 5.25 in May, and they'll keep it there. And the longer they keep it there, the more restrictive it's going to feel. And at a certain point, we are going to get things begin to crumble. Now, the inflation story has got to right itself as well. But we know that the Fed has got a dual mandate. They've got to look after inflation. But if the economy begins to crumble, they need to switch that focus back towards the economy, which is why by the time we get to Q4 this year, we're of the opinion that the Fed is cutting rates. That's not deviant from what's discounted in the marketplace. It's just that we're slightly more aggressive than the marketplace is in terms of rate cuts by the end of this year.
M2, can you talk to me about money supply? Is that something we should be more focused on?
M2 is through the roof and has been for quite some time. What interests me is the realness coming from M2. So let's talk about deposits. Deposits are very significant. They're currently around 18 trillion. There's been a lot of discussion about the fall off in deposits in the banking sector. I would argue that this economy, the US economy, has an excess of deposits. If you look at where loans are across this economy, there are around $12 trillion worth of loans. That difference between loans and deposits is anomalous. Why is it there? It's there because the Fed has been engaging in QE since the great financial crisis. That's the outcome of M2 and money supply. That's what you get. You get an excess of deposits in the system.
So money supply contracting, good news, a feature, not a bug of what the Fed's trying to do?
Absolutely. And also, the fall in deposits that we've seen since the middle of last year, which has been ongoing, will continue and shouldn't be an issue. It's to be expected. If the Fed is engaging in quantitative tightening, you should expect bank deposits to ease lower and trend towards where loans are printed. I mean, loans are considerably below deposits. So that's a natural process.
So how do you deal with the criticism that people might levy and say, this has been going on? As you pointed out, lending standards already were tight. And yet when we look at the earnings of some of these companies, they're stronger than expected. They're still passing along price increases. Consumers are still spending. This doesn't look like a recession.
It doesn't, Lisa. It doesn't look like a recession right now. Now, we've had a recession in tech. The banking sector has had a bit of a shot across the bows. We're looking at the real economy now. Now, I think the bit that interests me in particular, and the bit that I kind of struggle with, is if we have a recession, we're typically talking about a blue-collar recession. We're typically talking about restaurant workers getting laid off against the backdrop where currently we still have an issue getting restaurant workers. So that's the juxtaposition, and that makes the whole narrative quite difficult. But at the same time, you know, we've got to look at the full picture, and the full picture suggests that we will have pressure on the economy, increasing pressure on the economy, coming from the level of rates, coming from the tightening and lending standards over the next number of months and quarters.
So let's talk about the flip side. Are you saying that this recession will be a white-collar recession for those particular workers in areas like tech, in financials, in some of the areas that beefed up their staff during the pandemic.
So far it is, and that's how we get to a blue-collar recession. The white collar goes into recession,
and then their end follows
Right.
everything else. So then when it comes to markets, usually credit is the harbinger of what's to come. It is not flashing red. If conditions are so tight, why aren't you seeing some more concern being baked into corporate credit spreads and some of these other instruments that people look at as tea leaves?
No, absolutely. It's an excellent point, Lisa. We run various correlations between credit spreads and the economy. And if you look at the PMI numbers at the moment, they're suggesting credit spreads should be much wider. I think the answer is twofold. One, we have a huge demand for fixed income out there. I mentioned the discrepancy between loans and deposits. The residual there is going into fixed income securities. So the banking sector are big buyers of securities, and they're being forced out the credit curve. And that acts to force the entire market out the credit curve. So we've got that happening in terms of demand for securities. Anytime we've had a bit of a hiccup on the marketplace, for example, Silicon Valley Bank, primary has gone down for a few days, maybe a week, and then it's back up again. So there's big demand. That's the first point. So there's a flow argument. The second point is that I don't believe the marketplace is necessarily sold on this notion that we're heading into recession. I think there's a belief out there that we're going to soft land. So we have a different opinion. We think we will have a bit of a bumpy ride. So we're talking about, falls in output of about 0.5% to Q3, 0.5% to Q4, requiring the Fed to come in and cut rates. We're expecting delinquencies to start to creep higher. We're expecting defaults to begin to creep up. And we are expecting to see a credit spread implication, wider credit spreads in consequence.
Parag Lovett, as always. Parag Garvey there of ING Financial Markets. Recovering just a little bit on First Republic, very briefly trading in the 5s, back in the 7s, down 11% in the pre-market. The broader market, the S&P, just about positive on the S&P 500. Coming up next, Congressman French Hill on the debt ceiling debate. That conversation just around the corner.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Speaker Kevin McCarthy is confident his bill linking a debt ceiling increase to spending cuts will pass on the House floor this week. This despite divisions within his own Republican Party that threatened to vote against his proposal. Some don't agree with the measures, ethanol tax breaks, and work requirements for Medicaid recipients. The U.S. will gradually lift sanctions on Venezuela if the country moves toward restoring fair elections. That's according to Deputy National Security Advisor John Feiner. He spoke in Colombia, where there's a summit aimed at restarting negotiations between the Venezuelan government of Nicolas Maduro and the opposition. Shares of Google parent Alphabet are higher after the company reported first quarter results that beat estimates. Alphabet's cloud unit turned a profit for the first time. Meanwhile, its dominant search business weathered the economic downturn. The UK has delivered a huge blow to Microsoft's proposed $69 billion takeover of game maker Activision Blizzard. Antitrust regulators have vetoed the deal. That said, it could result in higher prices, fewer choices, and less innovation for gamers in the UK. And there's a sign that the Netflix's crackdown on password sharing could backfire. The streaming giant lost 1 million users in Spain for the first 3 months of the year. That's according to market research group Kantar. In February, Spain became one of Netflix's first markets to introduce a fee for users who share their login details with another household. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.